current Fed, or do they start to focus on the rhetoric of the shadow chair? One way or another is going to be entertaining.
So next week we get an SCP from the Federal Reserve. We're all going to be sitting at it, looking at it, going over the statement, the news conference, and the new forecasts from the Fed chair and the committee. How useful are those forecasts when we start thinking about 2026 just a little bit more?
So I don't mean this in any kind of disrespectful way. Sure. I think the Fed does great work. However, we probably pay less attention to those forecasts now than we have at any time over the last 5 years, because this is, for criticisms that are real or imagined, this is a Fed that has been more reactionary, right? To be data dependent is by its very essence to be reactionary. And so we know that this is a Fed that wants to be on hold. We know that this is a Fed that thinks inflation may come through. We're generally of the view that the risks to growth are greater, and that by the second half of the year, it's going to be apparent that cuts are appropriate. And so we think a federal funds rate today that's 4.25%, 4.5% needs to be somewhere closer to 3% over the next 18 months. And we think they're going to do that once the data pushes them there. So they can kind of write down what they want in June. That's great. You make a plan until you get punched in the face, and we think they're going to get punched in the face in the second half and realize that they need to cut.
White House policy might punch them in the face as well.
Yeah.
The White House policy has changed a lot over the last month or so, particularly on trade. Andrew Bishop of Signum Global Advisors joins us now for more on that front. Andrew, welcome to the program, sir. Some form of agreement between the US and the Chinese late into yesterday evening over in London. What did you make of the agreement that has been made, and ultimately how much progress are we making?
So the first thing I'd say is that the way that the agreement was described, sort of this framework around a consensus, et cetera, has been pitched as a word salad, right? As sort of a bit of a nothing burger. And I think that might be a slight mischaracterization in the sense that clearly what was agreed in Geneva was not detailed enough. These are issues, when I say these, I'm referring to the export controls around rare earths and others that are quite technical in nature. And so it actually makes sense that the administration would spend several days laying out a roadmap of exactly how many rare earths, under what timeline, under what schedule, with which approvals are going to be unleashed by China and reciprocate. So I actually think that I definitely am not in the camp arguing that this is a big victory, far from, but I think it actually makes sense that they would have spent a lot of time hammering out the details.
Andrew, this is the second round of talks, first Geneva, then London. It's still early, but could you give us your early thoughts on how different these negotiations are compared to what we saw take place in the 18 months of negotiations in the president's first term to achieve a phase one deal?
Yeah, very big differences. The first difference is that neither party, and I would say especially the US side, is interested in negotiating. So it can sound counterintuitive given that we're talking about a negotiating process. But my understanding from this administration is that there is, in and around the president's orbit, a sort of level of fed-upness with negotiating with the Chinese. And there's this view that there's really no point going back and forth to Beijing, to Shanghai, or hosting the Chinese here in Washington, D.C. And so ironically, I would not expect a lot of additional trade negotiation rounds, right? So that's the first thing. The second big difference is that we're not talking about trade. We're talking about export controls. Now, you could argue that that's export controls around goods that are being traded, but what I mean is we're talking about choke points and small volumes of highly politically salient goods, not about large volumes of goods. The third biggest difference is that China really holds the cards this time. That is definitely a turning point. Ironically, China always held this sort of choke point around rare earths, but wasn't willing to use it. Now that they've shown they're willing to use it, the U.S. essentially has lost pretty much all leverage in the short term. It can regain that leverage over the medium term, but in the short term, until the U.S. sorts out this rare earth challenge, President Trump really has the lower hand, if you will.
Andrew, speaking of that leverage, right? You're dealing with a situation where the United States, outside of the UK, has chosen to prioritize China in terms of deals, right? Where we may have expected deals with India or Japan or other allies. Do you expect to see more progress on deals with those allies in order to regain leverage and kind of encircle China? Or do you think they're set on this course of doing China first?
No, so I definitely agree and think that the primary goal, like basically the China stuff is damage control. The primary goal is definitely negotiating with the partners and quote unquote friends and allies, including around containing China, as you mentioned. And by the way, that's one of the big reasons why the relationship with China is so fraught, which is that the administration wants to have its cake and eat it too. It wants to have China send over rare earths, but at the same time wants to continue the agenda of essentially decoupling and forcing other countries to decouple from China. That's obviously irreconcilable. I do think we're going to see a greater emphasis on the allies. Now, to be clear, our view at Signum is that July 8 is going to come around, and the president is essentially going to increase tariffs.
Andrew Bishop with the latest of Signum Global Advisors. Are you expecting the same thing? Get close to the middle of July and expect higher tariffs?
I think you might see it in isolated cases for folks that aren't playing nice, but generally I think you're going to see more deals between now and then.
Futures right now negative by 0.2%. Big morning coming up, 8:30 Eastern Time. US CPI in just a moment, a preview with Torsten Slok of Apollo. Live from New York, you're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Three days of gains on the S&P 500, up over that period by close to 2%. This morning, pulling back just a little bit. We're down by close to 0.2% on the S&P. On the Nasdaq 100, down by 0.14. In the bond market, the main event later this morning, 8:30 Eastern Time. US CPI just around the corner. Your 10-year at the moment, 449.38. Last month, when we got CPI, we closed that day at 446.50. We've actually started to trade in a really tight, narrow trading range on a 10-year maturity over the last couple of days, if not the last month or so. So let's see what this morning brings. And then later on this afternoon, a 10-year auction, $39 billion of 10-year notes coming to market at about 1 p.m. this afternoon. So two things to watch a little bit later on in a trading session. With 3 hours until the cash open, let's get you some morning movers. Let's catch up with Yahara Arnott for more. Hey, Yahara.
Hi, John. We start with Tesla leading the Mag 7 higher. We're seeing it jump 2% here in the pre-market. The boost following Musk saying that he regrets some of the things he said about Donald Trump last week, admitting that they just went too far. He also made news on another front, announcing that Tesla's robo-taxi debut will be on June 22nd, not this Thursday, as we were reporting. So mark your calendars for that. And we switch to another automaker here, General Motors, up 0.7% in the pre-market after the company said that over the next 2 years, it'll invest $4 billion into U.S. plants. It'll use that money to boost production of its top-selling gas-powered vehicles. All of this, of course, as a way to blunt the impact from Trump's tariffs by making more of its vehicles here in the U.S. So this is a clear sign from GM that it's accepting the current environment and playing the hand that it's been dealt. And last up, we end with steel stocks. They are falling. Take a look at Cleveland-Cliffs, down more than 7%. Nucor down more than 3%. After we here at Bloomberg reported that the U.S. and Mexico are nearing a deal to ease tariffs on Mexican steel. The agreement still being finalized would let U.S. buyers import Mexican steel duty-free up until a certain amount. It's a shift from Trump's recent push to double tariffs on steel to 50%, but the move, of course, could pressure these steel producers. John?
Yahara, thank you. There are obvious, coherent, I think they've articulated the policy on the trade side in certain dimensions in a coherent fashion, but Steve, when I think about steel tariffs, I struggle. Maybe you can help me. Why are you putting a tariff on something to protect an industry that is so small relative to the rest of the economy when downstream producers that you want to protect and help, autos, for instance, are going to suffer?
Yeah, I think the administration views steel as a national security issue. I think if you're going to make ships and you're going to make weapons and you're going to make tanks, there's a belief you need to have some domestic production of steel. And so I think that's part of it. I think the other part of it is President Trump identifies himself with kind of that Midwestern, Appalachia steel worker. I think that's kind of his core constituency. So I think this has a little bit of a special place in his heart. I think what's most interesting about that news, though, John, is the Mexico deal. Mexico has played this round of the trade war, as well as any country. You haven't seen them in the headlines. You haven't seen the president pushing back. And I think the administration increasingly looks at Mexico as a place where you can have some of that lower value-added production that they'd like to see leave China, move to, right? Where we're not going to make sneakers in the United States, but you can make them in Mexico. So I'm very interested in seeing what that deal brings if they bring it to fruition.
Do you think that's because the Canadians operate from a place of confidence because they have USMCA on their side?
No, I also think the other thing that's at play here is this administration views the allies differently. I think in their world, India, Saudi Arabia, Mexico are maybe a little bit more strategic in terms of their long-term geopolitical objectives than Canada, Europe, and the UK were over the last 50 years. And I think you see that a little bit.
That's the latest on Mexico and a steel story. On our radar this morning, our top story, the US and China reaching a compromise after 2 days of negotiations. Officials agreeing to a framework that needs to be signed off on by President Trump and by the Chinese leader, Xi Jinping. Elsewhere, the Tesla CEO, Elon Musk, saying he regrets some of his social media posts during his public feud with President Trump last week, saying they, quote, went too far. In the pre-market, the stock is doing quite nicely off the back of that apology. The stock is up by almost 2%. And finally, the European Union thinks US trade negotiations could extend beyond President Trump's July 9th deadline. Sources telling us here at Bloomberg, the EU says the best case scenario is an agreement is reached on the principles of a deal by the deadline. Bloomberg's Brendan Murray joins us now from Brussels with more. Brendan, I guess not unexpected. It takes a long, long time to agree a full, comprehensive trade deal. What can we expect by the early days of July?
Well, I think in terms of this European situation, that they're coming up very quickly on this July 9th deadline, and there's not a whole lot of progress to show for it yet. So what they're going to hope for, and their best case scenario, is that there's some sort of tentative short-term arrangement to say, here are the targets we're going to shoot for to keep continuing these talks. Let's postpone the 50% tariffs that President Trump has threatened to put on the European Union and keep talking at the negotiating table. We're seeing a similar kind of situation play out with the U.S. and China talks, to where they can barely, it takes a month to figure out what they agreed to in Geneva. This is what they did over the past couple days in London. It took them 20 hours to figure out how they were going to implement this, the pledges that they made a month ago in Geneva. So I think what we're seeing is these noisy trade wars turning into this slower, duller sort of slog that they often can be if you're dealing with complex, massive trading relationships that have taken decades to build up the imbalances that they've had. To try to undo those in a couple of weeks or months is looking more and more unrealistic.
And Brendan, not just negotiate these things all at the same time with different countries, but negotiate different things with different countries. What stands out about the London talks is it was primarily about export controls. When you think about Europe and the EU, what's the focus with the Europeans? How different are those conversations?
They seem to be very different in terms of the tone that the administration, the U.S. administration, is striking. The mood, the body language out of the Commerce Secretary and the U.S. Trade Representative last night when these negotiations with China broke up was a sort of we have a kind of a trust but verify sort of situation now with China. With the U.S. and Europe, it seems that there is there's a lot of room for the U.S. to try to impose these tariffs and to, as we report today, to come out with some sort of asymmetrical solution for the U.S. The Europeans are not going to take that. They have retaliatory plans in place to strike back. So that is where it seems like there's a de-escalating mood happening between the U.S. and China, at least for now, and the U.S. and Europe, we could see some escalation before we see the temperature go down in that situation.
Brendan, appreciate the update on the reporting. So that's the latest on the trade talks at the moment. Today at 8:30 Eastern Time is about how the policy bleeds into the economic data. US CPI due out at 8:30 Eastern. The estimate in our survey expecting core CPI to increase by 0.3% month over month. Torsten Slock of Apollo writing, the consensus expects inflation to rise in the US but fall in the Eurozone. Torsten joins us now for more. Torsten, let's focus on the US side of things, and then we can get to a more global dimension. Let's focus on the US with the tariffs in mind. Is it too early, Torsten, to expect those tariffs to show up in the data this morning?
No, it's not. What really is the key issue here is that there is indeed going to be some upside pressure on inflation. And what's most critical about this is that it's all about the behavior among companies. How do they respond to tariffs? Do they pass on 100%? Will they pass on 50%? Or will they pass on nothing? If they pass on nothing, of course, then tariffs have to be absorbed by the E and the PE ratio, namely by earnings. So it becomes very important, the data print today and for the coming months. And we should expect to see some upside pressure on inflation coming from tariffs. But it's also the upside pressure we're watching that's coming from what's going on with the dollar. The dollar is down quite significantly since the beginning of the year. This is also beginning to creep in as a risk to the upside for inflation. And finally, the other thing that's also beginning to become a risk is that the restrictions on immigration. We saw last Friday some upward pressure on wage inflation. This is also something that's an upside risk to inflation over the coming months. So the bottom line to your question, Jonathan, is that we should expect to see from a number of different forces upside pressure on inflation for the next several months, including in the data today.
Will it be sustained beyond the next several months, Torsten? As you alluded to, as you indicated, that is the key question right now, the central question for a lot of people in financial markets. What is on your dashboard that guides that for you?
Well, my dashboard is to type ECFC go on Bloomberg and look at what the consensus is expecting, and that will tell you that CPI is expected to go up from 2.6 to 3.3 by the end of the year. So that's roughly a half a percentage point increase in inflation, and that's the same for core PCE and for headline PCE. So the issue there is that we should expect to see this take quite some time, because it all depends on the company's behavior in terms of when do they begin to implement higher prices on the back of inflation going up. And that is something that in the profile of inflation unambiguously pushes us up above 3%. And this is very important because the starting point, if we had started with inflation today at 1.5 and we had 0.5%, then we will get much closer to the Fed's target. But the problem is that the levels we're at, 2.8 of inflation today, is already at a level that is significantly above the Fed's target. So if you add a shock of lifting another 0.5 percentage point to inflation, that really complicates the Fed's job and therefore makes it very difficult for them to cut rates in an environment where there's so much upward pressure on inflation.
So Torsten, in an all other things being equal world, right, when you slap a tariff on, the price of those goods move up. I think that's clear. There are some offsets, though, potentially, and I'm interested in your thoughts there. One, right, energy prices have been lower now for a kind of sustained period of time, so there's some disinflationary potential there. Also, the ISM service number last week came in below 50, and so there's some signs of slowing in the service economy. So how do you think about some of those potential offsets, and do you think they're enough to maybe stunt the impact of what you're expecting from a tariff perspective?
No, you're right. From a growth perspective, lower energy prices is certainly helpful. But core PCE and core CPI, of course, excludes food and energy. So from the Fed's perspective, they would likely focus on that there is general upward pressure in the broader measures of inflation, excluding food and energy. And to your services, it's right. NFIB has been showing some upside pressure also on the expectations to inflation. There's also some measures, of course, of inflation expectations, both from the University of Michigan and the Conference Board, that is also telling you that inflation expectations are way too high relative to where the Fed would like them to be. So you're right, there are some nuances in terms of, yes, there are different things going on in some of the, especially survey-based data of what's going on with inflation, especially when it comes to household expectations being very, very high. So combined, I would still come to the conclusion that I worry more about the upside risk. This is also what the Fed has in their own forecast. That's what the consensus is forecasting. That's also what we're forecasting. So for what it's worth, I still think that the overall risks, yes, surveys may show that ISM was a little bit weaker when it came to prices paid, but the bottom line is that the tailwinds coming from tariffs, coming from a lower dollar, coming from restrictions on immigration are just pretty strong. And that's combined with, at the same time, a slowdown in growth, partly because of tariffs, of course, also weighing on sales for companies, but also a slowdown in growth because of the new factor that's emerging, namely consumers are beginning to take a hit now because student loan payments are restarting. And people are beginning to take a hit on their credit scores if they don't pay their student loans. So the New York Fed is estimating that's as much as 6, 7, 8 million households that now are at risk of no longer being able to get credit. So that's a headwind to growth, while we at the same time have some upward push on inflation. So that's stagflation in a nutshell as the baseline scenario that we view as the most likely case at the moment.
Torsten, that final point is so important. Are consumers in a position to eat it? And is the labour market tight enough for them to demand the higher wages to fund it? What's your assessment of that situation now?
So one way to assess that is, once again, to go to your Bloomberg screen and look at the Red Book same-store retail sales. That went up a lot just immediately during the Liberation Day weeks when we had, of course, a lot of people that were front-loading their purchases. But in the last several weeks, the same-store retail sales data from Red Book has started to show a seeping lower. We're now below 5% in nominal growth for same-store retail sales. We are watching that trend very, very carefully. And this is weekly data that comes out every Tuesday at 9 a.m. That will tell us something about, is the consumer really in such great shape as their balance sheets would be saying? Or are these headwinds, especially headwinds coming from tariffs, headwinds coming across the board, especially from the student loan problems that are beginning to emerge? And they only really started emerging here in May. And we are worried that the U.S. consumer could begin to slow down. And we're beginning to see some signs of that trend downwards in the Red Book same-store retail sales data.
What you're describing is potentially a nightmare for the Federal Reserve. You talked about the dynamics playing out in Europe. The ECB has been reducing interest rates now for a number of months. Torsten, where do you think it leaves the Federal Reserve at a time when I hear a lot of people saying they should just sit this out for the summer and maybe sit this out for the rest of the year?
That's extremely important because this issue is, of course, exactly that. If you have higher inflation, the Fed should be hiking. If you have lower growth, the Fed should be cutting. So which one is it? Does the Fed like apples? Do they like oranges? How much weight do they put on inflation going up? How much weight do they put on growth slowing down? And the dual mandate is torn in two completely opposite directions. That's why the easy answer to that for the FOMC members is to say we're not doing anything. But exactly to your point, Jonathan, what if the inflation data does start to move up much more? Or on the other hand, what if growth starts slowing down more? It's a really difficult spot for the Fed to be in because monetary policy works with a lag. FOMC members will say that's as much as 12 to 18 months. So it's almost impossible for them to catch this falling knife because we just don't know at this stage whether the growth slowdown will dominate or whether the rise in inflation will be dominating.
Hey, Torsten, provocative stuff. Appreciate the catch-up. Torsten Slok there of Apollo. Throwing out there the stagflation base case, at least for him. I know you look at things slightly differently.
Yeah. So, I think what was laid out there very eloquently is the consensus view in the marketplace, which is that tariffs are both negative to growth and they're a push higher in inflation. I do think there are some offsets, though, right? I think those lower energy prices over time then start to seep into other prices. I think at the same time, we're not going to see all of those tariffs implemented. You're only going to see some fraction of those implemented, and so. Our view is that represents that wall of worry that we're talking about. I'd also say, John, on the Fed, there's an old adage if you're approaching a stoplight and it's going from green to yellow, the right thing to do is stop. The wrong thing to do is run it. The worst thing to do is stop in the middle of the intersection. And while I do get that there are pressures on both sides of the dual mandate, I think the Fed needs to choose. Are they going to run the light or are they going to stop? We're generally of the belief, again, that the risks to growth outweigh the risks to inflation. I think you're going to see that become apparent over the next several inflation readings, this summer.
We get one more later on this morning, 8:30 Eastern Time for US CPI. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's catch up with Yahara for more. Hey, Yahara.
Hi, John. A legal victory for the president on the trade front. A court has ruled that Trump can continue to enforce his global tariffs. The U.S. Court of Appeals for the Federal Circuit extended an earlier reprieve for the administration, which is challenging a lower court ruling that blocked the tariffs. Arguments are scheduled for July 31st. Meanwhile, SpaceX called off a mission that was supposed to take off this morning. 4 private astronauts were scheduled for liftoff to the International Space Station with NASA and Axiom Space. But the launch was delayed to fix a liquid oxygen leak that was found during inspections of the rocket. SpaceX says a new launch date will be announced once the repairs are complete. And PIMCO saying they are cautious on private credit. In a new report, the firm warning that current stresses could worsen sharply in a recession, but Fortress Investments has a very different take. Co-CEO Josh Pack speaking to Lisa, our own Lisa Abramowitz in LA.
There's a large trend towards kind of private credit taking market share away from the commercial banking system. And we've seen that in a number of different products, whether that's real estate, private credit, forward flows, consumer finance. And it's we think it's a terrific opportunity. We think it's kind of a long-lived opportunity.
Coming up at 2 p.m. this afternoon, Lisa will be sitting down with DoubleLine CEO Jeff Gundlach at the Bloomberg Credit Forum. That's your Bloomberg Brief. John?
Don't miss it. Yahara, thank you. A must-watch conversation coming up a little bit later on this afternoon. Up next on the program, losing confidence in U.S. debt.
Foreign investors presumably are moving out of the longer end of the U.S. curve and going into the safer zone in the shorter end. I think in part because they've lost some confidence in the dollar, in part because they've lost some confidence in the ability of the U.S. to manage its deficit.
That conversation up next with Jeff Yu of BNY from New York City. You're watching Bloomberg TV.
incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The bond market in focus this morning. Treasury yields look like this. Yields higher by 3 basis points, close to 450. Later on, 8:30 CPI. Later on this afternoon, we get some debt supply. Under surveillance this morning, losing confidence in U.S. debt.
Foreign investors presumably are moving out of the longer end of the U.S. curve and going into the safer zone in the shorter end. I think in part because they've lost some confidence in the dollar, in part because they lost some confidence in the ability of the U.S. to manage its deficit. We may have to see higher yields to equilibrate demand and supply. A lot of narratives, a lot of trends out there that are inflationary and tend to move people away from a willingness to buy nominal assets.
So here's the latest this morning. $61 billion in Treasury notes up for auction between today and tomorrow. That will gauge appetite for U.S. debt. Joining us now to discuss is Jeff Yu of BNY. Jeff, welcome back to the program, sir. Let's just talk about this from an international perspective. How is this supply being viewed by investors beyond the shores of this country?
Well, I would say it's being talked about a bit more than being acted upon. If we look at our flow data of late, if we look at the plus 10-year part of the curve, external demand has actually been pretty good, I would say. Around Liberation Day, there was also interest in that. And we think that rather than talk about the Treasury side of things, the actual release valve has been in the dollar. So for an international investor, seeing a 30-year at close to 5% with euro-dollar at 115 probably offers more value than the 30-year at, let's say, 150 basis points lower and euro-dollar at parity. So I think that's the dynamic right now.
Jeff, do you think sentiment around Treasury has exceeded kind of the reality? I mean, there's been a lot of negative talk about kind of demand for Treasuries, but if I'm looking on a kind of 3-year basis at, 4.5%, we're kind of in the middle of where the 10-year yield has traded. So what's your perception of kind of negative sentiment versus the reality and how the Treasury is trading?
I would certainly agree with that in terms of looking at our flows again. So yes, there was some liquidation around the second half of April in the parts of the curve. I'd hazard to ask that foreign investors tend to own, right, in the more liquid parts, but they actually have come back. So looking at the long end, duration interest is there, and now I actually ponder if duration interest is signaling some concern about growth, not just in the US but globally. So that sense of using the Treasury market as a proxy for safety, notwithstanding the current noise right now, that still very much is in place based on our flow data.
Jeff, we certainly had a lot of conversations about a repricing of US growth from 2% down to something closer to 1%. Have you had the same conversations in the Eurozone yet? And do you see that appropriately priced in financial assets there?
Well, I think from the Eurozone, they're in two minds right now. So, do you worry about, in terms of the drivers for growth, you still have the long-term demographics. How about the productivity side of things? Can US maintain that? Maybe some discussions there. But from the Eurozone's point of view, looking at, some areas of stock markets, for example, in the industrial and defense side, is the market actually a bit over-expectant on European trend growth? Are we pricing 1.5 close to 2? That's where I think Europe should worry a bit as well. Where's the execution of the fiscal plans?
This would introduce the ultimate pain trade for me, Jeff. A lot of people are talking about the pain trade being a higher equity market and maybe lower bond yields. Steve was talking about that earlier. What about a stronger dollar? I can't think of many people out there that believe we'll see a stronger dollar into year-end. Euro dollar right now close to 115, and I'm hearing people talk about a 120s just around the corner. Would you push back against some of the dollar bearishness of the past few months?
Yes, and in the same way that I have been over the last 18 months, I would say, in terms of 110, 120 range, I'd be closer to 110 towards year-end. I think two main reasons. One, ECB would push back against it. If we're not going to the last meeting, but the meeting before that, Madame Lagarde, many members, they were very, very vocal on Euro starting to restrain financial conditions. And secondly, if we talk about dollar valuations, should the dollar weaken over time? Yes, but maybe it's dollar versus APAC, dollar versus some EM names on a basket basis. That's where the release valve needs to be, rather than euro-dollar itself. So we're probably talking about the wrong proxy here for ultimate dollar valuations.
Jeff Yu of BNY. Jeff, appreciate the update. Thank you, sir. Steve, just a final word. Is that a trade you like as well?
Yeah,
maybe a stronger dollar.
This is a happy one. I couldn't agree with Jeff more. I think that the ultimate pain trade right now is actually yields that come down. And I think a dollar that strengthens in the middle of the year, particularly when you pass BBB.
Steve? Enjoyed this. It's good to see you.
Great hour, John.
The hour has whizzed by. Steve Chevron there of Federated. Up next, Dan Skelly of Morgan Stanley, Ed Mills of Raymond James, Bob Diamond of Atlas Merchant Capital, and Mike Schumacher of Wells Fargo as we count you down to inflation data later this morning.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
The whole narrative right now is focused on tariffs.
In the trade data, you've had this massive volatility.
An outcome could take as long as 18 months or longer. For the most part, these tariffs are here. They're here to stay.
Unless it really re-escalates in a negative fashion, I don't think the trade issue is even going to be enough to kind of take the momentum out of this market right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Following 3 days of gains on the S&P 500, negative by close to 0.2% on the S&P. On the NASDAQ, we're down by a similar amount. In the bond market, the focus for a lot of you later on this morning and this afternoon, 10-year yields a bit higher, up by 3 basis points, close to 450 on 10s at 449.77. Going into this, your day ahead shaping up as follows. 8:30 Eastern time, so 90 minutes from now, US CPI. Then later on this afternoon, a dead auction of 10-year notes. Tomorrow, 30-year bonds. All of that still to come through the next 24 hours. We begin this hour with our top story. The US and China reaching a compromise.
We have reached a framework to implement the Geneva Consensus and the call between the two presidents. We had to get sort of the negativity out, and now we can go forward to try to do positive trade, growing trade, and beneficial to both China and to the United States of America.
Tracking these negotiations in London, Bloomberg's Anne-Marie. Anne-Marie, good morning. Give us the update, just how much progress we've made over the previous 48 hours.
Well, the progress they made, Jonathan, is basically going back to what they agreed upon 4 weeks ago in Geneva. But as Andrew Bishop of Signum told you in the last hour, he thinks this is more than just what some people are saying is word salad when it comes to this Geneva Consensus and this framework, which, by the way, we don't have written yet and haven't been able to read. He says this is about a little bit more of technical details, and officials had told me that. They were trying to work out technical details because what they are dealing with is technical materials when it comes to rare earth, these micro metals that are used in the U.S. defense sector, in the mobile phone industry, in the technology sector, and also when it comes to export controls. This is something China wants to see. And the key quote last night from Secretary Howard Lutnick when he was briefing me and other members of the press, he said, we do absolutely expect that the topic of rare earth minerals and magnets will be resolved when they're able to implement this framework. He went on to say, there were a number of measures, remember those export controls since Geneva the U.S. put on, things like jet engine parts, nuclear materials. He said that if the rare earths were not coming, then those will not come off. But you should expect those to come off, sort of as President Trump said, in a balanced way. So when China starts approving those licenses, when it comes to the rare earth and magnets, then potentially those export controls will be eased. The key question here is how far is the U.S. willing to go? When you say the export controls are for national security reasons, how do you then politically go back and say, actually, we need to ease them because we're not getting the rare earths? This is a huge piece of leverage Beijing has right now.
So, Anne-Marie, that's only one part of the conversation, export controls. Then we need to talk about tariffs more broadly. And then we need to talk about purchase agreements, which dominated the first round of talks in the president's first term. What's happened to all of that stuff? Because as far as we're aware from the outside looking in, it was barely discussed.
That's exactly right. And I asked USTR Ambassador Jamieson Greer about this, and he said, yeah, this will be part of a broader conversation when it comes to Beijing. But clearly, they can't have that conversation if they can't agree on these two sticking points, which, as Andrew Bishop and a number of individuals have said on our program, like Ed Mills, these are the choke points. And they cannot have that broader conversation until they get to an agreement on these two choke points for both of these economies, which begs the question, Jonathan. Those tariff rates in Geneva, that was the big win, right? Bringing those tariff rates, basically an embargo for trade on these two economies down to levels, 30% and 10% in respect to both of these economies, China and the United States. Well, that's only till mid-August. What happens if we keep seeing this escalation to de-escalate by mid-August? Are tariff rates going to go back up? And this is only one economy the United States is dealing with right now. They are still in ongoing negotiations with Switzerland, the European Union, Mexico, Canada, South Korea, Japan, and the list goes on. Remember, for those countries, the deadline is much sooner. That's on July 9th.
And before you go, let's take a beat on the Europeans. What deadline? They believe this is going well beyond July 9th.
A lot of countries think it's going to go well beyond July 9th. They think that if they at least get into an agreement of principle and potentially a meeting of the minds between Brussels and Washington, or Bern and Washington, or Tokyo and Washington, that they can get an extension of these negotiations. Because remember, trade deals are done in months and years, not days and weeks. And that is going to be very challenging when it comes to the timeline. Because remember, this administration continuously talks about an economic program that is a three-legged stool. And to have that tariff revenue, they need that to then also politically pass their one big, beautiful bill that is being debated in Congress. And all this looks, Jonathan, like it's going to drag well into the fourth quarter and potentially into the start of next year.
It's going to be a long summer, a long year, a long 12 months. Anne-Marie, thank you with the latest in the City of London. Here's the view here in New York on Wall Street this morning. Dan Skelly of Morgan Stanley writing, I'm fully expecting the market to chop around at 25 until it has more clarity on the depth of tariff changes. But our team believes that the 5,000 level that we hit during April lows was already pricing out this bear case outcome of a lost year of EPS. Dan joins us now for more. Dan, good morning.
Morning, John.
You're going to be with us through the hours. We've got time to work through a number of issues, but let's start with this one. What are we priced for now?
I think the key insight, and I'm thinking back to when we were together last in studio on April 7th at 7 a.m., the key insight was that tariffs would be negotiated. And a lot of people weren't convinced of that at that time. It was a very uncomfortable moment. We were down 20% for the year. So we fully retraced that, as you know. And I think what's priced in right now is this hope that we're going to have some negotiations in progress with the EU and China and Japan and many of our allies. But at the same time, that the economy is just going to continue to grind through, the consumer's not going to be affected, and that earnings and multiples are going to stay pretty lofty. And I think that's a lot of really high sentiment at the moment.
Let's sit on multiples, because I remember the conversation we had in early April. In fact, yesterday I cheated, I went back over the notes. And in the notes at the time, you said that maybe the multiple of 19 to 20, which was viewed as a floor, might start being viewed as a ceiling. Now we're at 21 forward times on the S&P 500. What is it now?
John, such a great point. There's two issues to think about. Number one, we're going to have a somewhat unfunded tax bill coming through the pipes in the next couple of months. That's going to lead to even higher term premia and a weigh on multiples. Number two, only about 10% of companies during 1Q took any tariff-related impact into their guides for the year. So as we get through July, as we get through October, and we have somewhat more clarity related to tariff levels, there's going to be earnings downgrades coming. And I think the best way to think about that in context, go back to 2018, which I think not enough people are talking about, frankly, but we went from a 1.5% average tariff to a 3% tariff. It was enough to create flat earnings for 2018, 2019. So how can we go from a 3% rate today to even the best case scenario, which is still unknown, of a 12% rate and not have an earnings impact?
I'm pleased you brought up July 2018, because the conversation lasted 18 months before we ended up getting a phase one deal in the first month of 2020. And as we said on the program yesterday, that phase one deal was quickly forgotten about once we got into the pandemic. You've brought up an important point. Later on in the summer, there is a belief that the bill needs to be paid, that the data we've seen so far only reflects a front loading, and the data has been flattered by the front loading we've seen already. Is that basically what you're articulating to clients at the moment?
It is, and we would just argue that the Senate's version of the bill, which is likely to get some more steam, is maybe going to add upwards of $1 trillion more to the deficit in the coming years. And so, yes, rates have kind of stayed in this very steady level of around 4.5%, but I would argue rates are going to touch 5 before they touch 4.
Okay, deficit spending has not been bad for stocks over the last 15 years.
Correct.
Why does it start becoming bad for stocks this time around?
I think it's based on a number of things, but at the same time, over those 15 years we were doing deficit spending, globalization was still working its way through the P&L of a lot of business models. You had this massive explosion in U.S. tech and growth. And so I think on two fronts. Number one, deglobalization or slowbalization, as we're calling the new tariff paradigm, is going to be an impediment in many cases to certain P&Ls, number one. And number two, you're reaching just law of large numbers as it pertains to the concentration of Mag 7 in tech in the U.S. market. And then even more broadly, Jonathan, thinking about the U.S. market as a percent of global markets in ACWI, multi-decade highs. So law of large numbers is running up against those issues going forward.
You know what the pain trade is? The pain trade is the equity market keeps climbing higher. There's a second aspect to the pain trade. JP Morgan has communicated this in the past week, that narrow leadership continues. The tech just keeps outperforming.
Feels like it.
What's the biggest threat to tech? Where does that come from?
So I guess I would say in terms of tech, seeing maybe a delay or a slowdown in these use cases of AI adoption. And look, at the moment, that story really is playing out, I think, on the positive front. So you're seeing Mag 7 not only start to see return on investment in terms of their wild spending ride of the last several years in CapEx, but you're seeing monetization evidence in software and consumer internet. And so I think the market is willing to wait and wait for the Fortune 100 and the corporate American AI adoption cycle to play out next year. But we're going to have to start to see more evidence of that.
What are you telling clients to do right now?
Right now, we're saying that 6,000 is a level where you want to, frankly, trim or rebalance on the equity market. I would just argue, again, higher rates relating to the tax deal and term premiums, uncertainty still on tariffs and where they net out in terms of the earnings impact. Let's look at the China news over the last several days. The new agreement looks a lot like the old agreement of several weeks ago, so not a lot incremental there. And then just candidly, John, I would argue it's somewhat alarming that our best allies, particularly on the military front, Japan, Korea, India, weren't the first to make deals very quickly because they would have exerted the best terms and the best leverage for themselves. So that's, I think, a little bit worrisome.
Rebalance out of what and into what? Are you rebalancing out at equities at the index level, market cap weight, specific sectors, into what after that?
Mostly at the market cap weighted level. And we're telling folks that the downside is not draconian. It's really not another bear market. It's probably 5 to 10% over the summer. And look, we've seen this movie how many times, John, over the most recent couple of years with summer liquidity and seasonality. We saw it last August with the yen carry unwind as an example. That was a 9% drawdown in 12 days. So I would just argue over the next 3 to 4 months, this is a time to take a little bit of money off the table at the market cap level.
Futures right now negative by 0.2%. Dan Scully of Morgan Stanley will be sticking with us through the next 50 minutes or so. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. The EU sees trade negotiations with the U.S. extending beyond President Trump's July 9th deadline. Sources telling us here at Bloomberg the EU thinks the best case scenario is it reaches a deal in principle by the 9th, which would allow further talks to work out the details. The U.S. is expected to respond to the latest round of negotiations in the coming days. Meanwhile, Elon Musk is pushing back the launch date for Tesla's robo-taxi network. Bloomberg previously reported it would debut in Dallas tomorrow, but Musk now plans to unveil the service on June 22nd. But noted the date could shift again due to safety concerns. Tesla hopes to autonomously deliver a vehicle from the factory to a customer's home on June 28th, which is Musk's birthday. And NVIDIA is ramping up its AI ambitions in Europe. CEO Jensen Huang announcing a partnership with a French startup with French startup Mistral to build an AI cloud. Wang said Europe's AI computing power could grow tenfold in 2 years. NVIDIA is also expanding into quantum computing, saying the field is nearing an inflection point. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, awaiting final approval.
We have reached a framework to implement the Geneva Consensus. The idea behind all of this is for us to increase our trade with China.
Coming up this hour, Ed Mills of Raymond James with a US-China trade framework in place. We'll catch up with the former Barclays CEO, Bob Diamond, on the state of the banking sector, and Mike Schumacher of Wells Fargo counting down to CPI in just over 1 hour's time.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Waking up to this post from Elon Musk a little bit earlier on this morning, saying the following out on X: "I regret some of my posts about President Donald Trump last week. They went too far." Hearing from the president in the New York Post in an interview with them this morning on whether he could reconcile with Elon, "I guess I could." Better news for the stock, apparently, in the pre-market, higher by 1.75% on that single name. For the broader equity market, let's start with the S&P 500. 1 hour, 14 minutes from now, U.S. inflation data. Equities into that following a 3-day winning streak, down by 0.3% on the S&P. On the Nasdaq 100, we're down by 1/3 of 1% also. Under surveillance this morning, awaiting final approval.
We have reached a framework to implement the Geneva Consensus. The idea behind all of this is for us to increase our trade with China, right? We have an existing significant trade deficit, and it's been President Trump's fundamental goal is to reduce the trade deficit and increase trade.
Here's the latest this morning. The US and China have reached a preliminary truce. Both sides are now taking the proposal back to their respective leaders for final approval. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, let's pick up on the language from the Commerce Secretary, Howard Lutnick, there, saying that the president's fundamental goal is to reduce the trade deficit and increase trade. What have they achieved in the past 24 hours that lends itself towards hitting that goal?
Yeah, hey, John. Well, really at the center of this, of course, as you well know, is trying to lift these export controls that the private sector has really sounded to the White House could impact their supply chains, including the auto industry. And we know that getting access, speeding up those export licenses when it comes to rare earths has been top of mind for President Trump. In fact, he said it was the #1 thing that he spoke about on the phone with Chinese President Xi Jinping last week, as China controls 70% of the world's production when it comes to to rare earths. Now, we are still waiting on what those critical details ultimately are going to look like, but it does appear that they were able to get past this impasse that really was in place in exchange for the U.S. lifting those new restrictions that they really did put into place in recent weeks as this started to escalate. And we're going to be watching closely if that does end up extending to those high-tech sectors such as jet engines or the software for AI chips, because at the end of the day, we need to keep in mind that this White House put those in place on the basis of national security concerns, and this really would be a reversal in policy. At the end of the day, though, if this ultimately ends up advancing towards what does seem to be a more lasting de-escalation, perhaps, as they continue these negotiations, then that would make good on the goal that Howard Lutnick is talking about, that they do want to keep bringing in this tariff revenue as those tariffs do remain in place, but it does perhaps allow them to negotiate towards a broader trade deal.
Tana, just before you go, the Treasury Secretary, of course, had to make a dash for the airport yesterday evening to get back to Washington, D.C. to testify on Capitol Hill. What are we expecting to hear from the Treasury Secretary later on this morning into the afternoon?
Well, I'll be heading up there shortly. He's testifying before the House Ways and Means Committee. In principle, this is supposed to be about the Treasury Department's next fiscal year budget request, but no doubt he's going to be asked questions about these trade conversations, but also, importantly, the reconciliation package, because keep in mind the chairman of this committee is Jason Smith, who is the lead tax writer on this tax package. And we know that the House is waiting for the Senate on some pretty critical details. Now, the latest reporting is that there has been one big hurdle that has been overcome, and that comes to no taxes on tips or overtime pay. We know the Senate wanted to make some changes there, but the House made clear that was a priority for the White House, and at the moment, it doesn't seem that's going to be left out of the package.
Tyler Kenner with the latest down in Washington, D.C. from the nation's capital. Tyler, thank you. Joining us now to discuss, to extend the conversation, Ed Mills of Raymond James. Ed, welcome back to the program, sir. Let's just sit on China and the U.S. specifically, that trade conversation. Are export controls becoming the main tool for negotiations now? And where does that leave tariffs? Is it a stretch to say that maybe the tariff story might already be done?
So export controls are hugely important, especially for the rare earths that China is restricting into the United States. We've talked about this on the show, that if we do not get access to this, our industrial capacity as a nation is going to be severely impacted. So a deal has to happen, John. What happens on the other side, how far Trump can go, I think jet engines, probably, the software, maybe. Loosening restrictions on semiconductors, that's going to be a really hard sell, especially on Capitol Hill, which is moving legislation to even go harsher on some of those export restrictions. You go back to his first term, John, there was sometimes when he cut a deal with China, and then he had a huge problem on a bipartisan basis on Capitol Hill. He needs to be careful as far he's willing to go here, because if he goes too far, Congress will pass something that pushes him to a different direction and could upend all of these conversations.
I'm pleased you went to the first term, Ed, because I went over that language from the Commerce Secretary, Howard Lutnick, just moments ago. We played the clip that the president's fundamental goal is to reduce the trade deficit and increase trade. One way they agreed to do that in the first term was through purchase agreements. How far away are we from purchase agreements this time around?
Well, if you go back to that March 2020, quote unquote, phase one trade deal, China almost did none of those purchases. COVID happened, Biden was elected. And what we've heard a lot from our contacts within the Trump administration is that before they think that they can really get into a lot of these negotiations, China has to start making good on some of those commitments. And so what I would be interested to see, and especially with what the Commerce Secretary said, if we are trying to reduce that trade deficit, China has to significantly up a lot of their purchases, especially on agricultural goods. That's something that this administration would love to see happen. I'm pretty optimistic that could happen. And I keep on going back. China on Trump 2.0 is really good at identifying choke points and identifying kind of who's in the room, kind of how the Trump administration is responding to this. They are coming at Trump very differently in his second term, which to me tells us that Trump is going to have to go a little bit further than he would like trying to get this deal.
Ed, good morning. Looking back now at the benefit of hindsight, some of the tech and semiconductor restrictions that were put on in the initial Trump administration back in 2018, 2019, people are now saying that they led to China getting more innovative around creating deep sea. Today, you're now hearing this news around rare earths and how essential and dominant that category is for China, and the leverage is now going back into China's direction. So I'm just curious, what is the next shoe to drop in terms of the unintended consequences of these really draconian tariff approaches by the administration? Is there yet another sector or industry that's going to be revealed in China's favor?
Yeah, so I think when we look at those semiconductor restrictions, I think you're absolutely right. There's a huge debate within the investment community. I get a lot of questions here at Raymond James about this, a huge debate in Washington, D.C. Were those effective? And I think what the problem for the president right now is that if you look at certain China hawks within his administration, what they would say is they need to be much more restrictive. If they're able to do things like DeepSeek, why are we allowing them to have access to any technology whatsoever? In my perspective, that's a huge concern for this tech restrictions to go far beyond what they are right now. Does it go into some of the lagging edge technology that had been off limits? The Biden administration said small yard, tall fence. Is this a much bigger yard? As it relates to the rare earth and critical minerals, what I expect out of the Trump administration is after we get through this bill, we've already seen executive orders trying to increase production here in the United States. Could we see a CHIPS Act for rare earth? Is this going to be a critical part of a lot of these trade negotiations? I'd say yes. Other industries, that's where we kind of look at steel, aluminum. That's where we look at pharmaceuticals. That's where we look at all of the 232 investigations. The Trump administration is already telling you what industries we view as national security that we're going to try to protect. Does that end in unintended consequences? Too early to say in my mind.
Ed, we've got a little bit of time. Let's finish on a different kind of hawk, a fiscal hawk. The July 4th self-imposed deadline. How achievable is that in your mind?
So what we said is that May was for the House, June was for the Senate, July is to work this out, August is to get this to the desk. They love to put artificial deadlines in place. I do think there's a decent chance that the Senate could get pretty close to getting this done by July 4th. What I don't know is how much of the details need to still be worked out between the House and Senate. Right now, it seems like what the Senate is trying to do is work with the House, pre-negotiate this, not get into a conference committee, try to get it to the president's desk sooner rather than later. I've always said with DC, I've never taken the under on timing. I've always taken the over, with the exception of this year. This year, this Congress has actually been able to come together and get things done. So I wouldn't completely dismiss it. I do think July 4th is too early. I think August is the real deadline, but it's remarkable. This is the most expensive bill in the history of the United States, and it has been largely without too many pitfalls. There's been hurdles, there always will be, but this bill does get done.
You're a wise man, Ed, and we appreciate the framing. Thank you, sir. Ed Mills there of Raymond James on the trade negotiations between the US and China and the path forward down in Washington for the tax bill. Up next on the program, we'll catch up with Bob Diamond of Atlas Merchant Capital on the state of the banking sector as we count you down to inflation data later this morning. That data, 1 hour away. Equity futures near session lows. We're down about 1/3 of 1%.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
60 minutes away from inflation data in America. Going into that, no real drama. 3 days of gains on the S&P. Give it into just a little bit of weakness this morning. We're down by 0.2%. Similar move on the Nasdaq 100, down by a quarter. Two things to watch for the bond market. Not just the inflation data later on this morning, but also the bond auction. $39 billion of 10-year notes ahead of that $22 billion of 30-year bonds that are coming out tomorrow. So lots of supply from the Treasury in the next 24 hours. Into that, yields just bleeding a bit higher, up 2 basis points. The 10-year 449.38 at the very long end of the curve. Seemingly can't get away from 5%. 496 this morning, up another 3 basis points or so. That's the cross-asset price action with 2 hours until the opening bell. Let's get you some morning movers. Here's Yahara Anand with more. Hey, Yahara.
Hi, John. We start with Lockheed Martin. Shares are now down 2.7% after we here at Bloomberg reported that the Air Force requested just 24 F-35s for next year. That is half of the 48 that it had expected. This, of course, marking a major blow for Lockheed Martin since the Air Force is the jet's biggest customer. I will note that the request, which was sent to Congress, could still undergo substantial changes. And now that we have that out of the way, we can move on to the fun. Take a look at my next stock, Dave & Buster's. Shares are up nearly 7% here, and that's after executives said that sales are picking up at the restaurant arcade chain as summer is underway. I will add that the company doesn't have a permanent CEO right now, but investors obviously optimistic about the business. And if you think it's all fun and games here at Surveillance, well, it is for now. We have our next stock, GameStop. Those shares, not fun are the moves. Shares are down nearly 5% because it posted weaker than expected results. Net sales were down 17% from a year earlier. And John, obviously that one was for you since I know you love to stay up all night playing video games.
Big gamer, massive gamer. I'm not a gamer at all. In fact, I think after 25, no one should play video games, but that's just my take on things. Do you? On our radar this morning, Yahara, thank you. Let's get back to our top stories. A curfew in place in downtown Los Angeles as anti-deportation protests stretch into a 5th day. Almost 380 people have been arrested since the weekend as crowds continue clashing with police over ICE raids. Elsewhere, the US and China reaching a trade compromise. Delegations from the world's 2 biggest economies striking a deal. Now awaiting sign-off from President Donald Trump and the Chinese leader Xi Jinping. And finally, the Treasury Secretary, Scott Bessent, is reportedly a top contender to be President Trump's next Federal Reserve chair. Sources telling us here at Bloomberg that a growing chorus of White House advisors are floating the Treasury Secretary's name. And they're the stories on our radar this morning. Let's turn to the financials. Citigroup expecting to set aside hundreds of millions of dollars more than it did last quarter for potential loan losses, a sign perhaps that the biggest U.S. banks may be bracing for economic weakness. Bloomberg's Herman Chan joins us now with more. Herman, is that just Citi? Is that the industry? Is it just the big players, or is it the regionals as well?
Right. So there's some mixed messages with respect to asset quality in our view. On the one hand, we've seen the Citigroup announcement that they're adding to bad debt reserves, and that will happen for many players in the banking industry, given the fact that there's some potential weaker economic projections going forward, given all the uncertainty. On the other hand, we've heard from a number of banks at this week's Morgan Stanley Investor Conference that their clients are doing really well, and they're absorbing the tariffs or passing on some of the higher pricing. So it's overall a bit of mixed message, and we'll see how it all shakes out over the next coming quarters.
Herman, you cover the regional players as well. If you look across the economy right now, any pockets of stress that they're struggling to deal with?
Yeah, I would say there are pockets of increased scrutiny, but not yet stress. So areas like trucking, manufacturing, those sort of areas that are more directly impacted by tariffs are areas that the bank management teams are scrutinizing much more closely. But on the other hand, the bank management teams are also saying that the economy is doing okay so far. Customers are still spending, and that's really propping up asset quality for the time being.
We heard an update at the conference in the last day or so that corporate and consumer credit was looking better than had been expected. Is that in line with really what you were thinking too, or is that more of a surprise?
That's right. So when we were into the first quarter earnings, there was a lot of uncertainty about where things were trending, but overall, the banks were saying that credit quality, especially with the consumer customers and the commercial customers, we're still holding up fairly strong despite all of the headline risks. So that seems to be a continuation a few months later, and there's nothing really surprising on that front. A lot of the banks are talking about early indicators like criticized loans trending better throughout the year. So that's a good indication that the banks have, at least for now, a good handle on credit quality with respect to the commercial side.
Herman Chan with the update. Herman, thank you. Herman Chan there of Bloomberg Intelligence. We can build on the conversation with a perfect guest. Bob Diamond, the founding partner of Atlas Merchant Capital and the former Barclays CEO. Bob, good morning. Good to see you.
Good morning, Jonathan. How are you?
I'm good. It's good to see you, sir. Let's just recap things. Where are we right now? Big 30,000-foot view of the banking sector in America. How are things shaping up?
You know, I think just kind of the back and forth, and on the one hand and on the other hand from Herman suggests pretty much my view, which is kind of a balance. You know, I think we'll see a turnaround in deal making, in advisory in the second half of the year that was a bit slower than people expected in the first half. I don't think Wall Street will repeat the kind of trading performance they had, which was kind of like Christmas in the first quarter for trading desks with all the volatility. But I think it's a good environment. So no big warning signs. I think as you said, the report from Citi that loan loss provisions are a bit higher is not surprising. I would be very surprised if they're more than a bit higher.
An okay environment for the big banks or for the smaller banks as well?
Well, it's a great environment for the smaller banks. And as you know, we're very focused on regional and community banks. We've done our first close in a investment strategy for that sector. We think that the 4,500 regional and community banks, one, they're incredibly important to the economy. They do over half of the lending to small businesses and family-owned businesses, but 4,500 is probably the wrong number. And many of the smaller, more private community banks that are so important to their communities are frankly just too small to succeed, with higher technology costs, higher regulatory costs, higher compliance costs. And Jonathan, what we're seeing is with a focus of our banking expertise, our integration expertise, the CEOs of these banks want to take part in consolidation. The opportunity to increase ROE through cost synergies, particularly on in-state transactions, is terrific. So I think in addition to that, as you look at the go-forward business opportunity, we have higher rates. They're probably trending somewhat lower, but not too aggressively, and very high demand for credit. So the environment could not be better for a strong regional bank today.
Bob, we often hear that tariffs and rates act as overhangs on potential M&A and consolidation. But stepping back, there's also a tremendous amount of disruption going on at an industry level. AI is disrupting many industries. You still have this transition in terms of office and real estate post-COVID. You have the energy transition, and we'll see what happens with reshoring. So would you argue that disruption in and of itself is going to lead to more industry consolidation and M&A across various sectors?
Yeah, I don't think that's a bad hypothesis, particularly with AI. I think looking at financial services again, which is kind of our expertise and our focus, it's nothing but positive in terms of, in the first stage, greater efficiency. And even where there's been that disruption in the U.S., the U.S. economy around uncertainty and tariffs, we have a couple of broker-dealers that we're invested in overseas, Panmure Gordon in the UK and Kepler Chevreau and Paris-based, but really focused on Europe for equity sales, trading, and research. They both had record earnings in the first quarter for flows from U.S. investors into the UK equity market and into the European equity market. It's incredible to me every time we see these disruptions. It's like the markets are reacting almost before we're ready to do the analysis. So those are first quarter numbers at Panmure Gordon and Kepler Chevreau, and they're records for the firms in terms of flows from U.S. investors into the UK and into Europe. So it's amazing how agile the investors are.
I was going to follow up and ask you about that because I know you have a very global experience throughout your banking career. And it's also just stunning to think about how soon the January American exceptionalism thesis turned into Sell America after Liberation Day. Do you see those trends in terms of flows and sentiment moving away from U.S. markets continuing, or is it more of a kind of a near-term blip?
I think there are reasons to continue. So one of the reasons is it's been a big divergence almost since 2008 and the great financial crisis, certainly in banks. But really in equities in general, the outperformance of U.S. equity markets has been very clear relative to the UK and Europe. So you had a bounce coming, and I think one of the catalysts for that is this administration's kind of gave a boot in the butt for the Europeans to say, we really have to focus on spending. We really have to focus on private sector. We really have to focus on the economy growing. And I think the attitude change across Europe and the attitude change in the UK toward private sector success, business, profitability has been positive for them. So I think the U.S. is still like the leading economy. It's so, the financial services industry is so deep. It's just such an impressive machine. It's not a negative on the U.S. necessarily. I think once we work through the uncertainty around tariffs, we'll see the strength. But a bounce in Europe and a bounce in the UK was coming.
Do you still see the policy mix from this White House as pro-risk, pro-growth?
I think, to me, Jonathan, the single thing that investors are looking for right now, well, there's not one thing, but if I picked one out, it's certainty. And I think, calming down the situation with U.S. and China would be a very big part of that. So I think the announcement today, if we move forward with solving some of those situations, I mean, keep in mind, if you go back like 10 decades, then, tariffs were like 2.5% on average. They got up to 25 or 30% with all of the noise. If they settle around 5 or 6%, I think we have confidence again and we have certainty again. And I think we'll have deal making come back. So I think this is a big moment. And I think what's been recognized is that China actually has some pretty strong cards. Rare earths is one of them. But, as you look at the latest numbers, China still had an increase in exports. Exports to the U.S. were down 30%, but exports to the rest of the world were up 11%. So overall, their exports were up.
So more than 20% to Vietnam.
Right. So less than 10% of their exports are to the U.S. today.
Dan, this is something you talked about. The last few months have revealed the leverage that the Chinese have this time around, maybe in a way that wasn't really enforced several years ago in the president's first term.
Yeah, absolutely. And I think there might be some positives that redirect and reorder some critical security-based industries, technology, pharma, medical supplies, et cetera. But I think the theme that I'm just hearing from Bob is one we just talked about with Ed earlier, which is this unintended consequences. We've given a kick to Europe to start spending and maybe in many ways created better growth opportunities for them that they wouldn't have taken on earlier, much like the DeepSeek analog.
Bob, does that mean that you're more focused on the US as everyone starts to look elsewhere? That maybe there's better opportunities here now?
Relative to the last 3 or 4 years, I think the opportunities in the UK and Europe are there. But Jonathan, one of the things we felt in Atlas Merchant Capital was one of our real competitive advantages in financial services is we're focused on the UK and Europe in the US. Prior to COVID, we had done just as many investments in the UK and Europe as we'd done in the US. Since COVID, it's been US, 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 because that's where the opportunities are. So I would say it differently. I hope we continue to see opportunities here. And US regional and community banks writ large, that's a phenomenal opportunity in the US. But if you give us more opportunities for growth in the UK and Europe, then Atlas Merchant Capital is going to be very, very busy. And that's the direction it looks like we're going in.
Just give us the number quickly again. What are we at now? Regional banks in this country? 4,500?
4,500, and it's probably the wrong number.
And you've got us coming down to what?
I think 3 years from today, market down will be at 1,000 to 2,000.
It's a punchy goal, that's for sure.
Punchy goal.
You could be a big part of it too. Bob, it's good to see you.
Good to see you, John.
Thanks for dropping by. Appreciate your time. Bob Diamond there of Atlas Merchant Capital. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross back over to Yahara for more. Hey, Yahara.
Hi, John. NATO allies are considering allowing contributions to Ukraine's defense in their new spending target, which is set to be adopted at a summit later this month. Sources telling us here at Bloomberg that Secretary General Mark Rutte is seeking to keep the U.S. fully engaged by getting member states to allocate at least 5% of GDP for defense spending. Meanwhile, General Motors says it's planning to invest $4 billion in its U.S. plants over the next 2 years. It's expanding factories in Michigan, Kansas, and Tennessee. It's also moving the production of several top-selling models from Mexico to the U.S. as it seeks to mitigate an estimated $5 billion hit from President Trump's auto tariffs. And the feud between President Trump and Elon Musk appears to be cooling off. President Trump told the New York Post that he doesn't blame Musk for anything and says he guesses he could reconcile with him. That follows a post on X from Musk saying he regrets some of his social media posts during the height of the feud. Tesla shares are higher in early trading, up nearly 2%. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in the next hour. Up next on the program, falling behind the curve.
Inflation comes down, the Fed is behind the curve, and we actually think them saying they're data dependent is not what they're doing. They're waiting to see what happens for the tariffs. They're going to have to probably cut more than the market thinks in the back half.
Tariff dependent and not data dependent. We'll get to that next with Mike Schumacher of Wells Fargo, live from New York. You're watching Bloomberg TV.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting this. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Quiet start to the morning so far, picks up later on this morning at about 42 minutes from now when we get a latest read for you on US inflation data. Into that, the scores look like this. Equity futures on the S&P down by a little more than 0.1%, pushing 0.2% lower on the Nasdaq 100. Under surveillance this morning, the Fed falling behind the curve.
Inflation comes down, the Fed is behind the curve, and we actually think them saying they're data dependent is not what they're doing. They're waiting to see what happens for the tariffs, which means they're not data dependent. That puts them behind the curve, and they're going to have to probably cut more than the market thinks in the back half because they've been waiting and waiting and waiting when they should be looking at the data.
Here's the latest this morning on the data. Investors are awaiting May inflation data ahead of a Fed rate decision next week. The estimate in our survey expecting core CPI to increase by 0.3% month over month. Mike Schumacher of Wells Fargo writing the Fed is boxed in. Inflation will be high for about a year, then return to a pretty normal run rate. Mike joins us now for more. Mike, good morning. Good to see you.
Good to be
here.
It's
been too long to see you in person, sir. Thanks for coming back in.
Absolutely,
let's pick up
a pleasure.
on that. What we just heard there from Matt Miskin, making a case that maybe this Fed risks falling behind the curve. Would you take the other side of that, given what you're expecting?
Not too much. I think it's really a feature, not a bug. The Fed wants to be, quote, late to the game. It wants to see evidence that inflation has peaked. It doesn't need low inflation, just simply some sign that inflation is not going a lot higher.
How much evidence will we see in about 40 minutes' time?
Not much. Probably see core come in at right around the survey, I would say, 0.28, 0.27, something like that. We have 2 decimal places now. People are paranoid about this, but not too much evidence yet.
Mike, how much are tariffs figuring into your inflation outlook? I mean, I guess just first thinking about this idea that vis-a-vis COVID first and then Trump 1.0, a lot of companies have flexed supply chains over the last 10 years. So is there going to be more flexibility in terms of people think in terms of the hit to inflation from tariffs?
Perhaps somewhat, but it's interesting when you think about the tariff effect. The markets tell a pretty tight narrative, actually. You've got inflation high for about 12 months and coming down to a pretty normal level. And that's actually what I think most economic models would tell you. And what can go wrong there? Perhaps there's a bit more inflexibility than we think. So we're still concerned. And I think, look, how much experience do any of us have with tariffs over the last 20, 30 years? Not much. That applies to the Fed, the ECB, any policymaker.
Absolutely.
You've got to be a little bit less confident going forward than otherwise.
And I would also just follow up to ask you about immigration. I mean, this has obviously been in the spotlight the last several days, and it's another part of this painful policy medicine that the White House is focused on first, in addition to trade. So how much are maybe the challenge or the slowdown in immigration trends hitting inflation?
Yeah, it's going to push up prices, I would think, in particular with some of the lower wage sectors. Think about agriculture, for instance, or some parts of leisure and hospitality. Who's going to harvest those crops in Texas, Florida? Not clear. You have to pay up.
Growth revisions in the US, super aggressive. I was reading the note you put out in the last week. You're doubting whether they've been aggressive enough in other parts of the world, including Europe. Just explain some of that for us this morning.
Yeah, I think it's interesting when you consider really some of the trade-offs between the U.S., Europe, and elsewhere. I would say the U.S. economy's got a very asymmetric effect going on right now, John. You think about any downturn period of weakness in my career, got a lot of gray hair, I've seen a few. It's always the case when the U.S. gets hit, it's big enough that every other economy comes with it. And our thought here is it's going to be a more limited set. So Canada, yes. Mexico, yes. China, probably, depending on the outcome of these negotiations. But the rest of the world, not so bad, frankly. So it's not something we've seen before. Europe seems actually okay.
And just also from a global perspective, obviously a lot's going on in terms of trying to negotiate some détente in Ukraine And on the other hand, another part of the world, Trump is negotiating with the Middle East in terms of flexing supply higher, oil prices lower. So how does that maybe global commodity picture pertain or blend into your inflation outlook as well?
Yeah, it's really interesting. I go back to the beginning of the Ukraine war in 2022. How long did markets really focus a lot on that war? A couple weeks, maybe a month. So I think maybe the unwind's a little bit more intense, but probably not a lot more than that. And it sounds a little bit cold, but the markets look at things like oil and core commodities. If they move, markets care. If they don't, then they move on to the next hot topic.
We have had a supply shock outside of the labour market. It's in the commodity market. It's crude. Crude's a whole lot lower than a lot of people thought it would be. With that in mind, how difficult is it to build a case for sticky inflation with crude down, energy prices down as much as they already are?
Yeah, it's a great point, John. You know, when you've got crude oil down a ton, it's the most important commodity in the world by far. And I think you've got to look at that and say, well, is that reflecting the idea that growth is going to be slower, or is it purely an OPEC thing and the Saudis are playing ball? It's probably a bit of both, I would say. Somewhat slower U.S. growth, whether it's recession or not, probably is not really the key point, but slower than we had been helps. But I do think it's the Saudis really saying, hey, we want to help out a bit. We'll keep prices down. And how long does that persist? Tough call.
Crude in the 60s is certainly helping out. Let's talk about the bond trade. Push it through fixed income. This from PIMCO. Maintaining your bias to be overweight in the 5 to 10 year part of the global yield curve and to be underweight the long end. The long end has become almost toxic to so many people. Can you construct an argument to be long the very long end of the curve?
I basically share the PIMCO views. So how would we come up with some method or some approach to make the long end attractive? I think you can get cute. You could have Scott Bessent come out in a couple months' time and say, hey, guess what? We're really going to cut issuance of U.S. 10s, 20s, 30s. We'll issue more in 2s, 3s, 5s, whatever. That probably buys 10, 15, 20 basis points for a while. But it's not just a U.S. issue. That's the key point. Think about government after government increase in defense spending. You saw the NATO comment the other day going to 3.5%. Maybe that happens, maybe it doesn't. Still, does it make you more or less confident buying 30s? Much less. So I think a lot of those things would have to reverse. I'm very skeptical this surge in defense spending reverses. That seems like a secular shift. Come back in a decade, we could talk about that, but probably not today. It's pretty tough to get super bulled up. I think the main argument, John, is that you get something like a recession and people focus on real yields and say, wow, they're really exceptionally high. So I think, to me, that's the case for buying the very back end of the curve, but it's a tenuous one.
The 10's at 450, 30's close to 5%, some auctions in the next 24 hours. Expecting any indigestion whatsoever?
I think a little bit on the very back end. So people still have very little appetite, but this is a well-told story. So perhaps the balance has swung a little bit too far. People are a little bit too bearish.
Dan, final word.
Negative.
Would you agree with that?
No, I think that makes sense. Absolutely.
It's good to see you, Mike. Thank you, sir.
John,
thanks for dropping by. Thank you very much. Mike Schumacher there of Wells Fargo and Dan Skelly of Morgan Stanley. Dan, thank you, sir. In the next hour, here's the lineup for you. Greg Peters of PGIM's going to join us to talk about this bond market. He'll stick with us through the hour as we work our way to US CPI data at 8:30 Eastern Time. We'll touch base with Geetha Raghunathan of Bloomberg Intelligence on media stocks. We'll speak to Seth Carpenter of Morgan Stanley and David Kelly of JP Morgan Asset Management. The next stop for this market, 8:30 Eastern Time. Inflation data just around the corner with equity futures down just 0.1% on the S&P and bond yields bleeding higher by a basis point or two. Your 10-year, 449.58.
Why is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do, And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We do believe that there's going to be volatility within inflation.
We will see the impact first in small parts of the CPI.
To think about it being stickier, you want to see it broadening out across the basket.
Still very much like the stagflation story.
We're only seeing the leading edge of the nervousness that's coming with the realization that we may be stuck in a higher inflationary regime.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. Inflation data 30 minutes away. The opening bound 90 minutes away. Your scores look like this. Equity futures pulling back by just 0.1% on the S&P. Similar move on the Nasdaq following 3 days of gains on the benchmark in America. On the S&P 500, a 20% plus rally off the April low, just 1.7% shy. Just within 2% from all-time highs on the S&P 500. That's the equity market turned to bonds. Fixed income, 2-year, 10-year, 30-year, yields bleeding higher. Back towards 450 on a 10-year maturity. On 30s, getting closer and closer to 5% again at 495.62. Going into this data later on this morning, this hour. US CPI, 8:30 Eastern time. Then later on this afternoon, an auction of 10-year debt before supply tomorrow on a 30-year maturity. That's your setup for the next 24 hours. We begin this hour with our top story. The US and China striking an agreement following 2 days of high-stakes trade talks in London. Your team coverage starts right now with Anne-Marie in the British capital, Tyler Kendall down in Washington, D.C. Anne-Marie, let's talk about the progress we made over the last 2 days.
Well, Jonathan, the progress is to implement something they already agreed upon 4 weeks ago when Scott Bessent, the Treasury Secretary, and USTR's Jameson Greer met their Chinese counterparts in Geneva. Obviously, we've seen both sides have a tit-for-tat. They're claiming that they reneged on their agreements in Geneva, and that's what led us to these talks more than 20 hours in the British capital between the U.S. delegation and the Chinese delegation. Ed Mills of Raymond James put it to you perfectly. What we are talking about over those 20 hours is politically salient topics and goods. When it comes to things like the easing up of export controls, which is a national security concern for the Trump administration, and when it comes to getting in return for that rare earth and magnets, which is a huge piece of leverage Beijing has, not just on the U.S. economy, but on the entire world, given the fact that they control more than 70% of really these micro metals. That's what these 2 days of talks were about. We haven't even gotten into broader issues and potentially the things like purchasing agreement, which was really paramount of the Trump first administration. Howard Lutnick, the Commerce Secretary, speaking to me and a few reporters, Jonathan, yesterday, after midnight coming out of Lancaster House. Already Scott Bessent was on a plane back to Washington, D.C. for his hearing this morning. He put it really well. He basically said that they absolutely expect the topic of rare earth minerals and magnets will be resolved. But he talked about when China approves the licenses, then you should expect our export implementation will come down as well. So that is going to be the balancing act we will see play out for the next few weeks.
Tana Kendall, let's talk about the balancing act down in Washington, D.C. The Treasury Secretary arrives back in the nation's capital. What's the message he's got for lawmakers on Capitol Hill?
Yeah, hey, John. Well, he wants to show lawmakers that they are making forward progress when it comes to a deal, because the White House really is motivated to show that they are moving this process along, considering that the talks with China really have sort of diverted the attention away from those other trade deals that they are trying to get done by that July 9th deadline that we're now less than a month away from. And really a big part of this is that the Treasury Secretary, often when he is on Capitol Hill, he tells lawmakers, yes, this is about tariffs, but also we have to look at the other parts of that economic agenda when it comes to taxes and deregulation too. And of course, this is the perfect audience for that. He's going to be in front of the House Ways and Means Committee. The chair of that committee is Congressman Jason Smith. He's the lead tax writer in the House, and they are waiting on those final changes from the Senate when it comes to the reconciliation package. And this administration is really pushing that this all goes hand in hand as they are trying to use tariffs also as that revenue raiser to help offset the broader impacts of that bill.
Just hearing from the president right now, Anne-Marie, in real time, the president's saying a deal with China is done. We will provide to China what was agreed to. Was this largely in line with what we're expecting this morning?
Well, yeah, because Howard Lutnick told us that him and Jameson Greer, Scott Bessent will take all of this back to the President of the United States. They said to me that they have been on the phone communicating with the President. They've been in London. And the Chinese delegation, which said the talks were frank, rational, honest. We're going to take it back to Xi Jinping. But I think the Commerce Secretary put it really well yesterday when he said, we expect those rare earth metals, those magnets, to come to the United States at a more advanced pace, and then we will ease up on the export controls. So they are just implementing, Jonathan, what they agreed upon 4 weeks ago. So this really feels like Geneva Part 2. And this was 4 weeks to de-escalate those escalations we saw only since Geneva. I think we just need to remind our audience that this is a long road ahead when it comes to the tariff and non-tariff barrier, these trade discussions, these national security concerns between these two economies.
Anne-Marie, Tana Kendall, to the both of you, thank you. We've talked about this a few times, the last round of talks. 18 months to achieve a phase one deal in the president's first term. 18 months, started in July 2018, concluded in January 2020. On the screen there, you can see the statement from the president, so let's talk about it verbatim. Our deal with China is done, subject to final approval with President Xi and me. Full magnets and any necessary rare earths will be supplied upfront by China. Likewise, we will provide to China what was agreed to, including Chinese students using our colleges and universities. We are getting a total of 55% tariffs. China is getting 10%. Relationship is excellent. Thank you for your attention to this matter. The latest on the trade story. The conversation pushes towards the economic data later in about 24 minutes' time. Will we see some pass-through from those tariffs to the inflation data? Then later on this afternoon, will we see some pushback from investors with the debt market receiving some more supply? 10-year maturity later on this afternoon, 30-year supply coming tomorrow. Here's the view on Wall Street. Greg Peters of PGIM writing the following. The market is worried about fiscal troubles globally. Leaning into risk into this environment is a fool's errand. Greg joins us now for more. Greg, good morning.
Good morning.
Let's pick up on that last line. Why do you believe it's a fool's errand right now?
Well, I've been surprised at how welcoming the market has been without any details, right? We're just talking about this latest, rocks for chip deal out of London. Details matter, right? And we're supposed to be detail-oriented investors, and the markets are really trading on kind of ideas. And I think ultimately we need to follow the data, which is why CPI and other things matter a lot, not just trade kind of these headlines that have no depth to it. So as a consequence, I think just chasing risk at very expensive levels doesn't seem to make a lot of sense to me.
As you know, we're trading the mood music because the data hasn't changed much, and people believe the mood music might inform what the ultimate data will look like further down the road. The data so far has been okay. I stress okay, and we can debate how okay. There is a belief that there will be a bill due in the coming months through the summer. We've talked about that throughout this morning. Are you expecting some kind of payback from the front loading we've seen over the past few months?
I do. Our expectation all along before kind of the administrative moves was the economy slowing. The question is how much. I think over the next quarter, you'll see the pull forward, so the data is going to seem a little more strong than it actually is, more of a mirage. I think the second half you'll have a better read, but that's highly contingent upon getting clarity. I think what's being lost here, even though everyone talks about uncertainty, we need clarity to make decisions from a business standpoint, from a consumer spending standpoint, and the longer this goes on, I think that lack of clarity translates into just lower economic activity.
From the investor standpoint as well, so growth at the start of the year in our survey was looking like something around 2%. Now it's closer to 1%. Inflation data around 2 to 2.5 for CPI at the end of the year. Now it's closer to 3. That 3, how sustainable is inflation closer to 3 versus, say, closer to 2? And do you see a source for sustainable inflation, not just in the policy, but across the economy through the year and looking out to 26 and beyond?
I do. I think inflation is clearly in the system. History tells you that once it enters the system, it's hard to shake out. So I don't know if it matters if it's 3.2, 2.8, as long as it's persistently above 2%, that target. I think that's what matters. And why it matters is because it translates into the Fed reaction function, right? So I think the markets have been so comfortable over the past, just call it 15 years or so, where any market swoon, the Fed would be there. It's harder to be there and to do much when you're above your target. And I think that's being lost in the conversation here. So I don't get caught up on the actual number.
Sure.
I get caught up on the fact that you're persistently above, and being persistently above just constrains those degrees of freedom relative to where we were when the Fed and other central banks were happy to be quite easy in hopes of generating inflation. So you have the opposite effect, and I think the market reaction will be quite different this time.
It compromises the dovish bias of the Federal Reserve. When you say the market reaction will be different, what are you saying? That we have to accept more pain, if there is indeed pain, than we otherwise would?
Yeah, the Fed just can't simply come to the rescue. The market's really comfortable with these idea of puts, right? These free puts, whether it's the Fed put, now it's the taco put, all these types of puts, right? Right? There's no such thing as free options and free lunches. And so I think the pain threshold is very different today than where we were, just before COVID, I guess.
That's risk and risk assets. Where does that leave 30s, 10s, the longer end of the yield curve? Do you consider that part of the risk asset bucket?
Sadly, I do.
Do you really?
I mean, it's not behaving in the way that it has over the past N number of years. And the reason why that is, quite simply, is the debt and deficit, of course, and the uncertainty and thus term premium. And so investors want to get paid more to be out the curve, to take on that type of risk. And so, our view all along has been the curve will steepen. I think one of the easier trades, Trump trades 2.0, was a curve steepener. That's playing out. The question is how much will continue. And I still think there's scope for that too.
Do you think that's a US-centric story or a global one?
It's a global story. But the U.S. matters a lot, of course, right, in the global bond story. But, what you're seeing in Japan, what you're seeing in Europe, And watching swap spreads globally is a really interesting phenomena where the U.S. Cash market has been trading cheap for years now. Europe has the opposite effect. But what the swap market is telling you is that there's abundance of collateral and people are kind of pushing back on it. And yield levels, maybe aren't cheap enough.
We'll get through the inflation data later. Let's talk about the debt auctions. If you don't think yield levels are cheap enough, what kind of levels do you think we need to achieve to clear the supply that we're going to see in the next few years?
Well, it all depends on kind of where the front end and growth and inflation. So there's a myriad of factors,
lots of different things happening.
But to me, just the onslaught of debt, right? So we're focusing on one auction, but then there's another one and another one and another one. And I think the cumulative effect matters. You have to watch some of the kind of the regulatory moves as well. Some might be positive, some might be negative. But either way, I see it trading cheap for quite some time.
5% is not cheap on 30s. Is essentially what you're telling me this morning. It's not cheap enough.
Evidently not. But
so you're looking for something closer to 6 on the long end of the curve?
No, I mean, it's clear, it's undeniable. Like there is this 5% threshold where investors get excited. So what we're seeing right now is it hits 5%, and it does garner this investor demand. But it's a moving target. So it might be 5% today, it might be 4.75 tomorrow, and 5.25, and so on. Either way, I think the point is that there's so much debt that needs to get refinanced here and financed, and that doesn't even include the additional debt, coming from this bill. It's a never-ending story. So it's wave upon wave upon wave.
Greg, you're going to stick with us, I'm pleased to say. Greg Peters there of PGIM Fixed Income, going into that additional supply later on this afternoon and again tomorrow. Bond yields this morning higher by 3 basis points at the very long end of the curve on a 10-year up, also by 3, closing in on 450 going into inflation data a little bit later this hour. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross back over to Yahara Anand, who has more. Hey, Yahara.
Hi, John. We start with the latest from the president on trade. He says the trade deal with China is done. Trump says the U.S. will provide China what was agreed on in talks over the past 2 days in London. Trump added the deal is subject to Chinese President Xi's approval. Meanwhile, here, California Governor Gavin Newsom is accusing the president of abusing his power by mobilizing troops in Los Angeles. Newsom issued a warning to other states saying, quote, California may be the first, but it clearly won't end here. Protests in LA over immigration raids stretched into a 5th night last night, and parts of the city's downtown are now under curfew. And a short list of names is emerging to be the next Fed chair. Sources telling us here at Bloomberg, a growing chorus of advisors both inside and out of the Trump administration are pushing for Treasury Secretary Scott Bessent to replace Powell when his term is up next year. President Trump said on Friday he would name a successor very soon. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next on the program, the Morning Calls Plus. We'll catch up with Seth Carpenter of Morgan Stanley, David Kelly of JP Morgan Asset Management, reacting to inflation data just 15 minutes away.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Got a statement from the president just moments ago. Let me share it with you. Our deal with China is done, subject to final approval with President Xi and me. The president posting that on social media just moments ago following 2 days of talks. Another round of talks in London between the US and Chinese delegation. The next stop for this market will be inflation data about 12 minutes from now. Your scores going into it shaping up as follows on the S&P 500. Almost unchanged really, no drama here. We're down by 0.1% on both the S&P and on the Nasdaq. In the bond market, yields are bleeding a little bit higher. 450 on 10s, let's call it. Let's round that up on a 30-year yield, getting closer again to 5%, 495.83. Then after we get inflation data, we'll hear from the Federal Reserve a week today. Greg Peters still with me. Greg, I've got to ask you, how much attention you pay to the forecast when the man overseeing the Federal Reserve, or woman for that matter, of course, might be very different to Chairman Powell in 12 months' time?
Yeah, so I mean, there is this belief that if you replace Powell, it'll be a much more dovish Fed. But I'm not convinced around that. You know, I think there's a difference between lobbying for the job and getting the job and then protecting your legacy. You know, I don't think, you know, any Fed chair wants to be known as someone who, you know, took inflation, you know, to a much higher plane, right? You know, the Burns legacy.
You think
really
the weight of the institution will shape the individual?
I do think that. So it might be a bias. So what are we talking about? Maybe 25, 50 basis points tops. It's not going to be the 100. It's not going to be radically different. So I think it's noise. The shadow Fed, I think, is also noise. I don't think it's positive noise, by the way. It just shakes the kind of the stability of the institution itself, which matters and matters a lot. But ultimately, you know, it's a board. I don't see it being radically different. Maybe on the margin.
That board gets together a week today to come out with a decision, a statement, a news conference, and some new forecasts from the Federal Reserve. Some new forecasts that will incorporate the latest economic data. CPI, once again, drops at 8:30 Eastern Time. The price action at the moment, equity futures negative by 0.1% on the S&P. Want to fit in some morning calls as well, so let's get to that. First up, Citi, raising its price target on Microsoft to 605, expecting growth in the company's Azure cloud service. That stock is down by 0.25%. Your second call from Baird, downgrading United Health to neutral, seeing risks to the path forward and the company's long-term trajectory. And your third and final call from Bernstein, raising its price target on Disney to 125, noting the stock has been on, quote, a roller coaster over the past 3 years. Let's stick with Disney. The CEO, Bob Iger, saying he plans to hold on to the company's traditional TV assets after streaming competitor Warner Brothers Discovery announced plans to split in two. Joining us now to discuss is Geetha Raghunathan of Bloomberg Intelligence. Geetha, welcome back to the program. What's the difference in approach between Disney and a major rival?
Yeah, thank you so much, John. So really the difference here is the amount of exposure that Disney has to the linear TV ecosystem, and that is really much smaller than some of its rivals. So you think about Warner Brothers Discovery, for instance, which announced that split just a few days ago. About 85% of their profit last year, John, came from the TV networks. Compare that to Disney at about, under 10%. It's a really different story. For Disney, it's really all about their parks business. About 55 to 60% of their revenue really, or rather of their profit, comes from the parks. So TV, not such an important part of the puzzle for them, really.
There is a puzzle, a piece of the puzzle on the TV side that's finally fitted into place. It's Hulu. Geetha, what's going to happen now? Disney has got its hands around it completely.
Yes, so now they have 100% control of Hulu. This is what they had wanted. The other 33%, so 1/3 of it was owned by Comcast. There was this fear out there that Disney would have to pay a much bigger amount to Comcast to kind of finally close the deal at about $5 billion, but that number came in much lower than expected. It was about close to $440 million. But really what this is all about, John, is about bundling. And with them getting Hulu, full control of Hulu, they can integrate it into the Disney Plus bundle, into the upcoming ESPN product. And remember, right now, the game in streaming is not about subscriber acquisition. It's really about subscriber retention. And gaining full control of Hulu allows them to do that. We know that having bundles curbs churn by something like 40 to 50%. So this is really what Disney's strategy is all about.
Geetha, I love Hulu, but I say this all the time. We're reaching the limits of my price tolerance, that's for sure. They keep putting prices up. In a moment, we'll get US CPI. As you look across the industry that falls under your coverage, how much consumer pushback are you witnessing, if any, at all?
Yeah, there definitely is. I mean, you do have the clear streaming winners, in Netflix, a little bit in Disney, which obviously have much more pricing power. But then you look at some of the other services. You look at a Paramount Plus, for instance, or a Peacock. Obviously, they have very limited pricing power. So we are kind of definitely reaching that point. But then content does become a differentiator there. So we've seen some of the leading streaming services still being able to take those price increases and keep their subscribers.
Geetha Ranganathan of Bloomberg. Geetha, thank you for the latest on the media sector and the price pressure we're all witnessing over the past few years on that front. CPI data is just around the corner. Mike McKee's going to join us now for a preview. Mike, we've been asking all morning, is it too soon to expect the tariff push through, the feed through, the follow through in this data? What are you expecting?
Well, we're starting to expect the clouds coming over the horizon, John. We may get some categories, particularly goods prices that come in from Asia, showing some increases, also automobiles because of the tariffs that the president put on. Not a huge amount of tariff impact, and there is a feeling that some service industries went down in price, airfares, for example, and that might limit the damage to the overall CPI, but it will be a sign that this is coming. And most analysts in their notes ahead of this are saying July, August, watch those numbers. June, July, August, watch those numbers.
Mike, are they saying it gets worse, not better from here?
Oh, yeah, gets worse from here. Because the tariffs are going to go on, and we don't know what the reciprocal tariffs will end up being, but we've already got the 10% tariffs. We've got the aluminum and steel tariffs, and then you've got pharmaceutical tariffs coming. Lots more tariffs to come, and that will just continue to add to the prices that you have to pay.
Mike, stay close. 6 minutes' time. Mike McKee's going to break down that economic data for you. Greg, just to come back to you. Mike's saying the base case right now. Consensus view, might be wrong, gets worse, not better from here on the inflation front. Do you agree?
Absolutely agree. It's way too early to be definitive, draw any conclusion. It's like the amuse-bouche of what inflation readings. We have a lot more courses in front of us, and this is very early on. This is just a little bite.
Not exactly tasty stuff, is it? Last time we got the SCP from the Federal Reserve, there was almost a dovish celebration that they viewed this, implied by the forecast, as a one-off hit, and inflation comes back down again in 26. Predates some of the tariff conversation. Does it change next week?
No, I think it's too early. The Fed definitionally has to be reactionary to this, right? They can't be out in front because they don't know what they're out in front of. And so, you'll continue to see a Fed on hold waiting for the play to develop, so to speak.
Does that include considering interest rate hikes? Because I haven't heard them entertain that idea at all, really.
That's not in the price, let's put it that way. So I think that would be a shock to the market. I don't think that's anyone's base case by any stretch, but it depends how it unfolds. But the Fed believes, and I think market participants believe that it is a one-time hit.
Greg Peters of PGIM is going to stick with us in just a moment. It's the data point you've all been waiting for. Inflation data in America just around the corner. We'll catch up with Seth Carpenter of Morgan Stanley, David Kelly of JP Morgan Asset Management here to react. Greg Peters as well, and Mike McKee will be breaking down the numbers in just a few minutes' time. From New York City, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Inflation data just seconds away, 20 seconds around the corner. Going into it, your scores shaping up as follows on the S&P 500. Negative by only 0.1% on the S&P. On the NASDAQ 100, we're down by not even a tenth, negative 0.06%. That's the stock market in fixed income. Treasuries, 2-year, 10-year, 30-year yields bleeding high at the long end by 3 basis points. The 30-year yield, 4.95.93. With the inflation data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, on a headline basis, certainly better than anticipated, up just 0.1%. The core is up just 0.1% as well. Last month was 0.2 for each of those, and the forecast was for a 0.2 rise in the headline and a 0.3 rise in the core. Now, for a year-over-year number, we do go up on a year-over-year basis to 2.4% from 2.3% for the headline. The core stays the same, 2.8%. So if there is a tariff effect, it is very small in these numbers. According to the BLS, the index for shelter rose 0.3% in May, same as it did last month. That's the primary factor for the all items monthly increase. Food, though, did go up 0.3. That was expected. An increase was expected there. Energy declined a full percentage point as gasoline fell. So that suggests that the services inside of the equation probably played a role in holding down overall inflation. I'll dig into the numbers, and you can dig into the markets.
Yeah, Mike, thank you. Stay close. That's what we call the right kind of downside surprise. I imagine we'll hear from the president momentarily. He'll have things to say about this. A downside surprise on headline CPI, on core as well. As Mike said, CPI month over month coming in at 0.1%. Our survey said 0.2%. That was the median expectation in our survey of economists. Excluding food and energy, core CPI month over month 0.1%, a much bigger downside surprise. We were looking for something closer to 0.3. This is how it plays out in the equity market first. Equity futures positive, bouncing off the back of it by 0.4%. On the NASDAQ up by 0.5. The outperformance, as you might expect, on the Russell, the small caps, the Russell 2000 up by more than 1 full percentage point now. Turn to the bond market. 2-year, 10-year, 30-year, focus on the front end of the curve on twos. Yields dropping by 5 basis points. Yields were up across the curve into the print, lower off the back of it, down 4 or 5 basis points on twos to 397.23. And once you've had a move like that, you unlock a bit of dollar weakness. So turn to foreign exchange. Euro dollar shaping up as follows now, near session highs. Euro dollar positive by 1/3%. Some euro strength, some dollar weakness. Euro dollar 114.66. With me around the table, Greg Peters of PGIM, Seth Carpenter of Morgan Stanley. Seth, just your first take off the back of that data. Not in line with what you were expecting.
No, that's exactly right. We were expecting roughly with consensus that it'd be up, 2-3 on core. I think one thing that's important to remember, though, is there are lots of moving parts here. We had already seen lots of swings in things like used cars before. We are coming into this year on a deflationary trend or disinflationary trend. And so, I think we got to just take this as 1 month's worth of noise. The other thing, though, is it's still early game. So when we look at what happened before with tariffs, it did take 2 or 3 months before you saw any sign of the tariffs and the inflation data, and so I think this is still the beginning of the game, not the end of it.
Timing and sequencing is really important. I know you've done the research because I've read it. The data this morning, you called it noise and not signal. What was the experience of the tariffs in the first term under this president, and the timing and the sequencing of things, the hit to inflation, then the hit to growth? And why should we think it's going to be the same this time around?
Yeah, I mean, I think what's really tricky is it does seem like the inflation comes from the tariffs after 2 or 3 months. The hit to growth comes after 2 or 3 quarters. And so that mismatch in timing, I think, makes it hard for markets, but very hard in particular for the Fed. I think in 2018, one of the big changes then versus now is that it was mostly focused on China. If you look hard in the core consumer goods data, you can see the effect of inflation, but it was transitory then. We have every reason to suspect it'll be temporary this time. But the numbers are bigger now. All around the world, tariffs, bigger tariffs on China, modulo whatever sort of deal comes out from London. And so we think there's a big difference there. Also muddying the waters, though, we know how much front-running there was before the tariffs coming in. So is that going to change a little bit, the pricing dynamic? Easily could do.
Greg, would you fade any excitement this morning around this print?
I would. I agree with Seth. I mean, it's way too early to make any kind of determination around this particular number. The one question I have for Seth, though, is, how do you think about 2 components, the housing component, which is key because that also feeds into growth, and then the service sector, which is basically a measure of wages and labor health. So, a lot of investors are excited around services disinflating, but that's actually kind of very much a double-edged sword. How do you kind of think about that?
Completely agree. It's a double-edged sword, and I think it's complicated. I think from the housing, it's a national phenomenon, and it really will reflect the tightness in the labor market. We've been expecting that to continue to drift down close to pre-COVID rates, month on month, maybe not going below it, but getting close to where it was before. For the rest of services, though, I think we have a countervailing force that needs to be more on people's radars. When it comes to policy effects on the economy, on markets, everyone's been focused on tariffs. Don't forget we've got immigration restriction. Immigration restriction matters a lot. We think prior to COVID, the run rate, sort of break-even rate for non-farm payrolls was probably 110, 120K. 2024, 2023, that run rate went up to 240, 250K. It's going to drop to something closer to 75. That's a meaningful restriction in the growth rate of the labor supply. And people here should remember what it was like coming out of COVID when it was hard to find workers. You saw hotel buildings, for example, where like the top 10 floors, for example, were just left vacant because they didn't have staff. I think those sorts of staffing shortages are very plausible, and that could be putting upward pressure over the second half of the year for the services outside of housing.
Not much pressure right now. If you are just joining us, a downside surprise on headline and core CPI. Month over month, it came in at 0.1%. The median estimate in our survey, 0.2 on core. Taking out food, taking out energy, it came in at 0.1 against the median estimate of 0.3. Mike McKee standing by. Mike, I want to come back to you. You've been digging through the details. What's the source of this downside surprise? Where's the surprise coming from?
Well, overall, John, it looks like goods prices did not rise. They were flat during the month, which is not what was expected. Services prices were down. Gasoline prices fell 2.7%, so that had a big weight. The thing that did prop up inflation was, as you guys have been talking about, housing, but a couple of other areas that did surprise. We saw a slight rise in home furnishings, about a 0.2%, but apparel is down by 0.4. That was expected to rise. And here's the real surprise in these numbers. Used cars and new cars both fell in price by 0.5 percentage point. The expectation was tariffs would drive those higher. Airfares were down, as people kind of expected, given the travel fall-off that we've seen, down 2.7%. So there are some surprises, some non-surprises in here. I was going to mention, John, you were talking before the number came out about the cost of Hulu and all those other subscription services. They were up 0.6%, one of the larger rises in the CPI this time. I think maybe what we're seeing is companies selling out of the inventories that they pulled in. That could be one of the explanations for not seeing kind of the tariff effect that we thought of.
Mike McKee, thank you, sir. We're all feeling that price pressure on the Hulu side of things, that's for sure. I'll talk about that another time, no doubt. Seth, what did you make of that explanation?
Yeah, I mean, I think what Mike said was there are a lot of different components that are going in lots of different directions. And I think that's exactly where we've been for the past, call it, year, where the underlying trend before the tariffs hit was a downward trend, but boy, was it not uniform. It was all over the place. I think the car prices point is a really important one. If you look at the month-on-month changes of both new autos and used autos over the past, call it 12 months, you'll see some big swings in both directions. And so again, the noise versus signal, the noise is very high right now.
Seeing some swings right now in the equity market and in bonds too. Equity futures near session highs going into the opening bell about 50 minutes away. The equity market is positive by 0.4%. Just move to the bond market, though. This interesting move here. Compare the 2-year to what the 30-year is doing this morning. People like Greg would call this a bull steepener. Rally at the front end of the curve. Yields dropping by 6 basis points. And a 30-year basically doing nothing. What does that speak to?
This speaks to everything we were talking about, which is, all the concerns manifest in the 30-year, right? So the front end is driven by Fed policy. And the back end is driven by a lot of other factors. And there is this pesky auction later this week. And so I don't really see a scope for that to rally into that auction. It normally cheapened up beforehand. So I expect it to continue to cheapen up beforehand.
A 30-year supply coming tomorrow afternoon, 10-year maturity. Issuing debt, the Treasury a little bit later on this afternoon too. So yield to lower at the front end of the curve. We're down 6 basis points on twos. That unlocks some dollar weakness. Euro dollar right now, 114.75. Joining us now to extend the conversation, I'm pleased to say, is David Kelly of JP Morgan Asset Management. David, I just want your initial reaction to the data we got about 10 minutes ago. Was that a surprise to you, sir?
Not too much of a surprise. As we were going into this print, we were looking at a lot of the different industries, and there's a sogginess in the economy which is really preventing prices from going up. I mean, one of the things that I was struck by was that both airline fares and hotel lodging were down, and that really jives with the fact that people flying and people staying at hotels in terms of occupancy rates have both been very solidly down for weeks, if not months here. And then at the retail level, I think it's just like businesses and consumers are eyeing each other nervously. Consumers, feel badly about the economy, not sure, and retailers just don't have the nerve to raise their prices until they absolutely have to. But I think the tariffs will mean they absolutely have to in the next few months because a lot of these retailers work off tight margins. So I think we're going to have a further delay to the delayed reaction to these tariffs. But if the current level of tariffs stick, we do still expect this inflation pressure to rise over the months ahead. And I think by the end of the year, we're talking about a CPI about 3.5% year over year, consumption deflator north of 3% year over year, even though it's taking some time for this to materialize.
David, here's a counterpoint. It comes from Neil Dutta of Renmac this morning, who said if tariff rates are up and core good prices aren't up by as much as the consensus thought, it implies more margin squeeze at retailers and less price pass-through. Why isn't that just going to be the sustainable story for the next several months? Why does it have to get worse?
Because the retailers won't be able to do it. I mean, these margins are tight, and what they're doing is, for their existing inventory, they paid a certain price for it, and they're willing to, even though inventories are going down, they're willing to, accept current margins. But as they have to pay for the new inventory and mark up on that new inventory, I expect that we will see those higher prices. So it's because margins are tight in the retail businesses, and I think it's going to be very, very hard for retailers and auto dealers and so forth to actually maintain low prices if the prices of the stuff that they're buying goes up.
David, if they're not in a position to eat it, are consumers in a position to pay the higher prices? Do you see a labour market that's tight enough to demand higher wages to fund that move?
Well, we are seeing a slight tightening in the labour market because, as your previous guests were talking about, that I think this immigration squeeze is beginning to hit. And I think it's very, very much below the radar because a lot of these people don't really admit to being working at all. But there's a shortage of labour, which is getting worse. And I do think that's going to put a floor under wages. And now for consumers overall, this is a tax on lower and middle-income consumers. I mean, that's what tariffs are. They're a tax on imports of goods, and that hits low and middle-income consumers. So it depends on the tax bill a bit, but assuming the effects of the tax bill don't kick in until later, then I think the squeeze is going to get worse over the course of the year, and you're going to see weak consumer demand, and so you're going to have a combination of an economy which seems to be pretty sluggish, say, the third quarter, but also prices which are registering pretty high year-over-year increases.
David, I've got to ask you, where on earth does that leave Chairman Powell and this Federal Reserve?
I think they have to wait and see what happens with this tax bill. You've got tariff inflation that's going to be followed by stimulus inflation unless they water down this tax bill. And I think he's right to wait and see. I mean, I also think that given how high the stock market is, he doesn't want to be responsible for causing a further party in the equity market and pushing asset prices even higher. So I think the Fed is going to wait and wait and wait until they know what the tariff story is and what the tax story is. And at that point, they can assess the economy. But until that point, they've really got no reason to ease.
David Kelly of JP Morgan Asset Management. David, thank you. Seth, you were following that conversation. Do you share that opinion the Fed's going to sit this out?
I do think so. I think right now there's no urgency for them to move. I mean, you saw the year-on-year number. Even with this downside surprise, the year-on-year number was 2.8. I haven't seen what my team has sort of done for the translation to core PCE, but you're still probably talking about something like 2.5%. And so even though that's well below the peaks we saw coming out of COVID, 2.5% is still a 0.5 percentage point higher inflation than the Fed's target. And to date, we haven't seen any deterioration in the labor market. So I think it's a very difficult proposition to argue the Fed needs to cut in June. Why not take the optionality, sit and wait? They can communicate their inclination to have the next move be a cut through their dot plot at the upcoming meeting. That seems fine, but I don't think there's any urgency on their part to move.
Have you got a clean read on their reaction function? They might not move, but do you have a decent understanding of how they would move based on incoming information?
So I think so. I think the simplest version of this, and this isn't going to be groundbreaking, is they've got two mandates. They have to worry about growth and employment on the one hand, they have to worry about inflation on the other. At any point in time, based on the current set of the data and then your best guess as to where things are going, which one's the bigger problem, and react to that one. And so right now, the bigger problem is very clearly inflation. It's come down, but it's still above target. The labor market to date is fine. Where are things going? Well, we start to make forecasts. We think inflation's going to go up from here. They probably think inflation's going to go up from here, but we don't know that yet. But until you get that confirmation, there's no reason for them to move. If we're right and inflation does go up, like I think is the consensus, before the labor market starts to slow, before spending in the economy starts to slow, well, that just reinforces the idea that inflation's the bigger problem of their two mandates. And so we've been saying for a while, don't count on a rate cut at all this year, because if inflation keeps drifting up before the economy cracks, makes it easy for them to just sit on their hands at the current level of policy rates.
Greg Peters, sitting on your hands through the summer is one thing, through the year is another. Are you expecting them to sit on their hands through 25?
It's data-driven, of course. That's my out. But we've been kind of penciling in two cuts just to get to kind of the top end of neutral. But it's a complicating factor. I think it's how you position the inflation. Clearly, they're going to be hesitant to use the word transitory, but there is this belief that it's a one-time shock, and you have to look through it. But my read is that they will prioritize growth. If you just kind of think about it, in the matrix, if growth moves down hard, I think we're pretty sure inflation's following, right? So I think they're worrying about and prioritizing growth over inflation, but they can't tell you that because they need to be credible on the inflation front. So you have to kind of look through, and kind of read in between, which is difficult to do.
Is that another way of saying Governor Waller has a luxury that Chairman Powell doesn't have?
Yes. But I think it's right, and there's some politics there too, right? So it's our belief is inflation rolls over. Growth rolls over. I think they'll respond to that, even though inflation remains well above target.
Greg, this was smart. It's good to see you as always. Greg Peters there, PGIM, alongside Seth Carpenter of Morgan Stanley. Seth, thank you, sir. Appreciate it. If you are just joining us again, just moments ago, and welcome to the program, we got inflation data. Downside surprise, 0.1% against an estimate of 0.2. That's month over month on headline. If you look at core and strip out food and energy, that came in at 0.1. The estimate was 0.3. In response to that, equities higher, up 1/3 on the S&P, up by more than 1% on the Russell. Bond yields are lower at the front end of the curve, unlocking some dollar weakness against G10 currencies. Euro dollar near session highs. I imagine the White House is going to respond soon as well. Bloomberg's Tyler Kendall joins us now for more. Tyler, we call that the right kind of downside surprise, not just for the economy, but maybe for the president too.
Yeah, hey, John, it's going to be a welcome report for this White House and expected to bolster the president's rhetoric when it comes to his tariff plans, particularly on the heels of what was considered to be a pretty big win for this White House last night when a court ordered that they can continue to invoke their tariffs under the International Emergency Economic Powers Act, IEEPA, at least for now until a hearing during the summer. So President Trump is going to probably double down on this message. And as you've been discussing, though, this really does come against the backdrop that this is sort of the beginning for the tariffs. We're not expecting them to go away anytime soon. And we also know those Section 232 tariffs are in the pipeline on the grounds of national security concerns such as pharmaceuticals. And that's why you're also going to see the White House push on that pressure when it comes to getting the House to pass that reconciliation package, because they still want to get cash into consumers' pockets as quickly as possible to get ahead of any certain tariff impacts here. That's really why we started to see that front loading of those tax cuts as part of this reconciliation tax bill, because they're trying to sort of front load those at the end of the day, even if there are those deficit concerns down the line.
Tyler, thank you for the update down in Washington, D.C. Tyler Kendall there, Bloomberg's very own. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross back over to Yahara, who has more. Hey, Yahara.
Hi, John. We start by recapping the latest economic data. Underlying U.S. inflation rose in May by less than forecast. It's the fourth month in a row that's happened. Core CPI rose 0.1% from April, lower than the expected rise of 0.3%. Data suggesting companies are finding ways to limit how much higher costs from tariffs they pass through to consumers. Meanwhile, President Trump says a trade deal with China is done. Trump says the U.S. will provide China what was agreed on in talks over the past 2 days in London. Trump added the deal is subject to Chinese President Xi's approval. And SpaceX called off a mission that was supposed to take off this morning. 4 private astronauts were scheduled for liftoff to the International Space Station with NASA and Axiom Space. The launch was delayed to fix a liquid oxygen leak that was found during inspections of the rocket. SpaceX says a new launch date will be announced once the repairs are complete. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, we'll set you up for the day ahead. A sneak peek of the calendar through the rest of this week and into next week. Live from New York City, you're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Three-day winning streak on the S&P 500 going into the opening bell about 37 minutes away. We're looking for day 4 now. Downside surprise on CPI, unlocking some gains this morning, albeit small gains. We're up by 0.2% on the S&P. On the Nasdaq, up by 0.25. In the bond market, yields lower, particularly at the front end of the curve. We're down 7 basis points, 394.52. And with that move, unlocking some dollar weakness. Euro dollar 114.65. As we count you down to that opening bell, just a sneak peek of what to look for today at 10 a.m. Eastern Time. The Treasury Secretary Scott Bessent testifying on Capitol Hill. At 1 p.m. Eastern, a White House press briefing. Plus, the U.S. selling $39 billion in 10-year notes on Thursday. PPI and another round of jobless claims, and we'll look forward to that 30-year debt auction too. And on Friday, going into the weekend, you mentioned consumer sentiment. Before we get a bigger read on the U.S. consumer next week, look out for Tuesday. Just something to note, look out for retail sales next Tuesday. Before we run off, let's round things up with Anne-Marie in the City of London. AMH, I have to say, a better morning for the president. Some form of an agreement with China. We won't make it too exciting when it's not. It looks like a lot of work to stand still, but certainly it's better than the other option. And then the data just moments ago. Downside surprise on CPI.
Absolutely, Jonathan. This is just yet another inflation print that came in less than forecast. Neil Dutta hitting the inboxes. I heard you mentioned him earlier. Unemployment is rising before inflation. He says the Fed has TDF. He's saying that's tariff derangement syndrome. Basically, the Fed is too focused on tariffs, and we're not even seeing it in the data just yet. I expect the President of the United States is going to take a similar tone to Neil Dutta shortly, Jonathan, on Truth Social when he wants to talk about those inflation figures. And then all of this, of course, has to do with what's going on with trade. The President talking about these talks that we had in London, more than some 20 hours at the negotiating table between the U.S. and Chinese delegations, and basically talking about the fact that they just want to implement what they agreed upon 4 weeks ago. What's key in the President's truth, though, this morning is that the rare earths will be supplied upfront by China, and he pretty much said that is going to happen immediately. So that is something that is music to the ears of these companies that need these micro metals, and China has complete control, really, on this supply.
Anne-Marie, appreciate the update. Head to the airport and we'll see you in the studio tomorrow morning. Anne-Marie Horton, thank you. Looking forward to catching up with you in person tomorrow morning. From New York, that is it for us. Thank you very much for choosing Bloomberg TV. Investors certainly rewarded for selling the fear and buying the hope. A 20% plus rally on the S&P 500 off the April low, and it continues going into the opening bell. Coming up tomorrow, Francis Donald of RBC, Sarah Hunt of Alpine Saxton Woods, former Fed Vice Chair Richard Clarida, and Lindsay Rosner of Goldman Sachs. From New York City, this was Bloomberg Surveillance.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings, for the world.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
All right, getting a little bit of a rally in futures. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, another CPI surprise. U.S. inflation data comes in below expectations, quelling concerns over price pressures. And concepts of a plan. The U.S. and China wrap 2 days of high-stakes trade talks with a preliminary agreement that really lacks detail. We'll try and suss that out. A Wall Street legend joins us to react. We'll get insight from one of the greatest traders of all time. Paul Tudor Jones joins Open Interest for an exclusive interview. Katie?
But first, let's take a look at how the trade is shaping up before the bell. You can see we have a rally on our hands when it comes to the S&P 500 in the pre-market, now higher by about 0.25%. That doesn't sound like much, and it's not, but we were really wiggling around pre-market, and it was CPI that boosted us firmly into the green when it comes to that bond market rally. 10-year Treasury yields currently lower by about 4 basis points, a bigger reaction in the bond market than you're seeing in stocks. And you can see the VIX volatility draining right now. That VIX trading with a 16 handle, Matt.
Wow, that's Liberation Day levels. The inflation print coming in softer than expected is really the main headline. Let's break down the data with Michael McKee. He's Bloomberg's international economics and policy correspondent. Mike?
Well, basically, Matt, we got half of what was expected in terms of the month-over-month increases. We did get a jump in the headline number on a year-over-year basis to 2.4%, but the core stayed at 2.8%, which was not expected. The big reason is because goods prices did not rise as much as people anticipated. They were flat on the month, while services prices rose only 0.2%. One reason for that is because gasoline prices fell by 2.6%. But a number of things that people thought would be contributing to higher prices for goods because of tariffs did not actually do that. Apparel prices down 0.4. New cars and used cars both down 0.5%. And airline fares down 2.7%. Housing, the big reason that we saw any kind of inflation, up 0.3 as usual, the owner's equivalent rent.
All right, great roundup. That is Bloomberg's Michael McKee. One of the top stories this morning. The other top story is the White House celebrating a string of trade wins. The U.S. and China have established a framework for implementing the Geneva Trade Agreement. but it still needs approval from President Trump and President Xi. Also, we learned last night that a federal appeals court has allowed Trump to continue enforcing his global tariffs through July. Let's break it down with Bloomberg Washington correspondent Tyler Kendall. And Tyler, bring us to that trade framework that we seem to have established with China. What do we know so far?
Yeah, hey, Katie. Well, we heard from President Trump earlier today saying that the deal is done subject to final approval from himself and Chinese President Xi Jinping. We know at the heart of this was really trying to get at those export controls, those recent restrictions that both countries have put on products that each other needs. Now, we're still waiting on details here, but negotiators did suggest that it does appear that China would be willing to speed up those export licenses when it comes to critical and rare earth minerals that are so essential to U.S. supply chains. And in exchange, Commerce Secretary Howard Lutnick suggested that the U.S. would lift or loosen export controls put into place in recent weeks. Our reporting suggests perhaps this could extend to the design software for chips, also jet engines, but we're going to have to wait and see. President Trump also said in a post on Truth Social that ultimately Chinese student visas might not end up being revoked as currently planned under the administration.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall giving us some of the detail that we have on that agreement. We're going to continue to suss more out of that for you and bring you that news as it is clearly market moving. We're seeing the Dow Jones Industrial Average, S&P 500, and NASDAQ futures all up ahead of the open. Now, we welcome our TV and radio audiences for a conversation with one of the most respected traders on Wall Street. Paul Tudor Jones made his name calling the Black Monday market crash in 1987, shorting stocks during the largest single-day percentage drop in U.S. history. Jones became a gold bull in the aftermath of the GFC and bought Bitcoin as the money printer went burr during COVID. He also founded the Robinhood Foundation in 1988 and has helped since then to raise nearly $3 billion to get New Yorkers permanently out of poverty. Paul Tudor Jones, a co-chairman and chief investment officer of Tudor Investment, joins us now on set. Paul, it's great to have you here.
It's great to be here.
Thanks so much for joining us. I want to talk first of all, before we get into the markets, economics, and AI, about your philanthropic efforts, and specifically a partnership that Robinhood has with Bloomberg in a contest called Pick a Ticker. You have a $10,000 bet, essentially, one long, one short. How did this contest go, and who was the winner?
Well, we did it right. It actually starts right before our investor conference that we hold every fall. This year we had 40 participants. We raised about $400,000 that went, 3/4 of which went to Robinhood. It was fantastic. The winner was Bill Ackman of Pershing Square. He was long Fannie Mae. And see, number 2 was a guy named Mark Gallant, who actually used to work for me, and 3 was Stan Druckenmiller. No surprise, he's going to always be placing. They came in, I think if you took the top 3 or 4 and you had made their bets, you would have made 7 times your money in 6 months. So it's a great competition. I really hope this year we can expand it so it'll be a much bigger group. It's $10,000. It's a 6-month competition, one long, one short, and yeah, it's a lot of fun actually.
Shout out also to Anna Nikolajewski, who got up there on the board with those.
She was our only female entrant. I hope we get a lot more ladies that'll participate this time.
So they have another chance coming up this fall.
Absolutely.
And I thought since we have you here, you could help us. Give us a tip. What's the one long you would hit for the next contest?
I would say probably the yield curve. It just depends on where it is. I think it'll be higher at that point in time. Mine would be very esoteric, so let me think. Well, I would definitely be betting on substantially lower front-end rates. We'll have a new Fed chair within 6 months of that point in time, and I think Trump's going to pick someone who's going to be uber dovish.
Well, let's talk a little bit more about the yield curve. Matt and I were actually emailing at like 4 in the morning about the yield curve because it's broken a lot of hearts, that steepener bet. And the way you lay it out, short end rates coming down, you have concerns about the deficit, potentially boosting the long end. It seems like a no-brainer, but it feels like it just hasn't worked. So what's different this time?
Well, it's working. It's just, you know, it's vol adjusted. It's just a slow-moving train. But I think in the long run, it has to work. We are fiscally constrained, and we're going to have budget deficits of 6% plus as far as the eye can see. So one of the major offsets, if I was the president, would be to lower my interest rate costs by appointing a Fed chair who is as dovish as could possibly be. That's kind of the playbook when you're 100% debt to GDP and you're fiscally constrained. You can see it happening in Japan right now. Wade is reluctant to raise rates more than beyond 50 basis points, even though they have inflation. Pick a number somewhere between 2 and 3%. I think they fudge the numbers down all the time. You got wage growth at 3.5% there. So that's, you know, historically the way that you get out of a debt trap is you run the lowest real rates possible. You lower your interest burdens, and I'm sure that's what we'll see beginning when the next Fed chair comes.
Well, we definitely want to talk about who the next Fed chair might be and who you would like to see. But let's talk first a little bit more about the deficit, because it feels like you take a look at the bond market over the past few weeks, the past few months, you can see those fears being expressed. But concerns about a higher deficit feels like one of those evergreen issues out there. So give us first your feel, how you're feeling about the deficit projections that we've been getting, and also how you might invest around that.
Well, the big beautiful bill is really interesting. It's first of all, it's a genius in branding. The name of it's a genius in branding. But I think what you got to do is you kind of you have to go to first principles. What would the actual budget look like if we were trying to balance the budget? If we were actually trying to balance the budget, what is the counterfactual to the big beautiful bill? So if you actually had to balance the budget, it probably would be the big beastly bill. And at some point down the road, who knows when that's going to be? Maybe it's next year, maybe it's the next administration, maybe it's 10 years down the road. At some point, probably, the bond markets are going to call BS on governments around the world playing chicken with them, right? So to give you an idea, if we were to balance the budget today, let's assume, first thing I would do if I was president, I'd appoint the most dovish central banker I could to lower interest costs. So let's assume that I could make a pact with my chairman of the Fed that I'm going to go through an austerity package. I'm going to balance it, but I need you to really drop rates to, let's say, 2.5%. So if you drop rates to 2.5% and you get a 50 basis point reduction, or let's say even a 100 basis point reduction in 10-year rates, that saves you $175 billion. The starting gap is $900 billion, so that saves you $175. Now I'm down to $725 billion that I've got to find through tax hikes and spending cuts. So let's assume that we're going to do this fairly. We're going to do 50% tax hikes in the rich, because they've benefited the most in the last 30, 40 years, 50% spending cuts. What does that look like? On the spending cut side, I would just to make it simple, let's just call it a blanket 6% reduction in everything: Social Security, Medicaid, defense spending, you name it. I'm just going to cut everything 6% across the board. That's what it would take to get you $360 billion, half of that $725.
Tough to do with Congress, right? You got to work.
I'm just saying there'll be a point where the markets are going to demand it. I don't know when it'll be. Maybe it'll be in my lifetime. Who knows when it'll be?
By the way, how do you invest around that? Because you famously made a lot of money shorting the yen and Japanese assets into the lost decade, which was another situation where you saw a country just boost its fiscal debt and deficits.
All right, I will get to that, but let me just finish the tax hike side.
Yeah.
So to get $363 billion in tax hikes, you're going to have to raise the top income rate to 49. You're going to have a 1% wealth tax annually, and you're going to have to raise the capital gains rate to 40. So if all we're going to do is stabilize debt to GDP, that's the big beastly bill that's somewhere down the road. And again, who knows when it's going to be. Remember, You have Italy, France, and Japan, who on the current projections will be in worse fiscal shape than we are, and they seem to be doing okay. And that's why we keep going with the kayfabe in wrestling, the suspended reality, where we like to watch the show, but we know it's not real. So we know that these 6% budget deficits are not sustainable in the long run, but it's okay because it's okay now. It's okay in the short run, and it feels good, and it's not hard. It's actually really easy. Remember, in the first Trump administration, he normalized 4% budget deficits. That's what we had pre-COVID. And now in this administration, he's normalizing 6% budget deficits. So, and I'm not judging, I'm just calling balls and strikes. That's where we are. So with that in mind, knowing that we have a whole pricing structure that's created on something that's not sustainable, it's really, really hard to invest for the long run, because the day that it'll probably be the bond market first, or maybe it's the dollar, who knows. The day that we're called to carpet on that, and the day that you actually went through that exercise that I just described, then you know that multiples on stocks will not be where they are right now.
Right.
But are you short the dollar? I mean, you mentioned you're into yield curves.
I would say that the easiest long-term trades are, you know the yield curve's going to steepen, probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that. A lot lower because of that.
How much lower? I mean, we're off 10% from our high right now. 8%.
Yeah, I would say I think that's a year from today. That's probably a realistic assumption.
I want to go to one point that you made in that blueprint that you laid out, and that comes to appointing the most dovish Fed chair possible. Jerome Powell's term ends in May 2026.
Right.
We've heard from the president recently that he's going to announce some contenders sometime soon. Bloomberg News has reported in the past 24 hours that Scott Bessent has emerged as a pick. Kevin Warsh is under consideration. I mean, if you had your pick, who do you think is best suited for the chair?
Those are two great names. Those are two fabulous names. Again, if I was president, if I just think about President Trump, he's a growth guy, right? He's a loyalty and growth guy. You're going to be my pick if you're loyal to me. You're going to be my pick if you're a growth guy. And I'd pick a growth guy, and probably Scott would be more in line with that than Kevin would. They will have had a really close working relationship at that point. I also think, again, the playbook's pretty clear historically and right now. We are fiscally constrained. We're in a debt trap. You're going to have to run negative real rates to get out of it. That's what we did in the 50s. We had, if you'll remember, we had a variety of prices fixed by the Treasury while we had 5 and 6% inflation for a period of time. We're going to have negative real rates, and that's why you have to think about what is facing our policymakers in this debt trap as you construct your portfolio. So what would an ideal portfolio be in something like that? Well, what has worked so far? What has worked so far has been some combination of stocks, which won't do great, which would do terribly if we ever actually had, if they called us out and the bond market actually gave us an accident that then spilled over. But it would be some combination of probably gold, vol adjusted, Bitcoin, gold, stocks. That's probably your best portfolio to fight inflation. Vol adjusted, because the vol of Bitcoin's obviously 5 times that of gold, so you're gonna do it in different weights.
You said at one point you would allocate 1 or 2% of your portfolio to Bitcoin. Is it still?
Yeah, I mean, I think you just, particularly now that the roadmap is clear, then I mean, again, if I'm a policymaker, I'm going to run really low real rates. I'm going to have inflation running hot. and I'm going to tax the American consumer to get out of my debt trap. And that's exactly what Japan, who's the most fiscally constrained in the world, doing. And it works until the population throws you out because you let inflation get too hot. So maybe you're in a world with 3.5% inflation and 2.5% overnight rate, and you're kind of trying to run hot and grow your way out of it.
Well, let's talk a little bit more about equities. You know, you mentioned in that scenario that you laid out, equities obviously would do terrible, but where we stand right now, I mean, we're back to 6,000-ish on the S&P 500. We're slightly positive for the year. It feels like after the big performance that we saw in May, though, that people are not sure where to go from here. So assuming we continue along this path where inflation is under control, it seems like the labor market is under control, and trade negotiations continue to progress. I mean, what's your base case on equities right now?
Well, again, so a year ago, I never thought the bond market would tolerate the big, beautiful bill. I just didn't think it would. I thought, wow. I thought there'd be a revolt. I thought bond vigilantes actually had some stuff. But
they've come back out?
But they clearly haven't surfaced. And
we haven't seen inflation.
Well, there's a couple of things going on. One, we know 12 months from now, rates are going to drop precipitously with a new Fed chair. Was it last week when Donald Trump saw was it ADP? I'd drop rates 100 basis points.
Yes.
So we know where his head is. We know who he's going to point.
Well, and just now, the vice president, J.D. Vance, said this is monetary malpractice in a tweet reply to our Joe Weisenthal. So they really want the Fed to cut rates.
So that also is a tailwind for the bond market, right? Because you know short rates right now aren't going to be there a year from today. So that's a tailwind. And again, I think the biggest threat to the stock market has been our fiscal profligacy, something like the big, beautiful bill, because that was always going to be a threat to the safety and security of the bond market, whether investors would tolerate what's going on. And right now, it seems like both globally and domestically that the world's okay with kayfabe, kicking the can down the road. We're going to suspend reality. It's okay. So, and in that scenario, again, if I have to make a decision on stocks and I think that rates are going to be 3% in 12 months, yeah, I'm probably long.
By the way, you keep mentioning kayfabe, and we're all kind of watching this knowing it's fake, but don't really care right now. Is that because we're not invested? Because Brad Gerstner has this idea, and Ted Cruz was on Bloomberg talking about it yesterday. I think it's Invest America, where you give every child born $1,000 and then allow parents or relatives to invest $5,000 a year. Then by the time they're 18 and the stock market continues to appreciate, they have a serious nut, but they've got skin in the game.
Yeah, I think it's. See, I'm the budget
hawk, and you don't mind spending $4 billion.
And the cranky guy, but that's the best $4 billion that would ever spend in history, because the idea of making kids stakeholders from an early age in capitalism is so important. Oh my gosh. And then allowing employers or relatives or whatever to build that account so that at an early age they understand the idea of entrepreneurship, of free markets, of self-individual excitement about understanding how productivity actually works, how we build things through our own sheer initiative. I think it's just spectacular idea. It's the best $4 billion this government could ever spend.
So there's a good way to add to the deficit, and there's a bad way. That would be the best $4 billion. I'm very conscious of the clock. We only have about 8 minutes left with you. So let's talk a little bit about AI. You've expressed concerns about AI in the past. In May, I believe you said that, I mean, it could be pretty disastrous if you think about, if you really put your thinking cap on. But I'm curious from the investment perspective, when you wear your investor hat, how do you view it then? I mean, there's plenty of things to get concerned about, but we were having a great conversation with Cliff Asness of AQR last week. He's had a real change of heart when it comes to AI. He's embraced it. Are you embracing it?
Well, for sure I'm embracing it. We tested 2 models last week internally. We have a variety of quant teams at Tudor. We tested 2 models, commercially available models. Where AI has gone in the last 4 months, is so incredible. These models do democratize quant modeling for the markets. Like, I can just think, I've been an investment in quant modeling for the last 30 years, internally, externally, a variety of ways. And what these new models do is, there's a huge barrier to entry if you think about quant modeling, which is I need to have dozens. If you look at the big ones, whether it's 2 Sigma or Jump or whom, they have hundreds, thousands of employees.
That's their edge. That's Cliff's edge, right?
With these new models, wow.
They lose the edge.
It's incredible what these new models do. And the reason that I bring that up, of course you have to embrace it in our business. There's larger issues regarding AI that I think, if you don't mind, I can't tell you because I don't really trade individual stocks that much. I'm actually using the models from a quant standpoint, so I can't tell you which companies to buy. It's pretty clear that this is obviously the most disruptive technology in the history of mankind. If I can just give you here's the way I think of AI. You're too young for this, but there was a great Twilight Zone.
Okay.
Great Twilight Zone episode where aliens came down to Earth and they had this, and they hand this book. It says "To Serve Man," and everyone goes, "Hooray! They're gonna save humanity. It's a humanitarian guide," and it turns out to be a cookbook.
I was ready to push back, but you called me out. I haven't seen that episode.
Yeah. So anyway, we just had our Robinhood AI Poverty Summit on Monday, which I was at. Oh my Lord, the things that AI are going to do for education. There is no excuse for a low-income kid not to have the greatest education if his parents or caregiver is taking care of them. My gosh, they're going to have an individual tutor to walk them through everything. So it's really spectacular. The downside of AI is that we've been served, right? When I say we've been served, you had in February Elon Musk. You can think what you think of him with regard to his moral compass, but he's the Thomas Edison of our time. Said AI has the 20% possibility of wiping out humanity. There's the safety side that should set off alarm bells throughout the world, particularly in this country, particularly with this administration. And then just last week, you had Dario at Anthropic. Amadei, am I pronouncing that correctly?
Anthropic is good enough.
So anyway, he said that in 1 to 5 years, we could have 10 to 20% employment because of the displacement of white-collar jobs by AI. So now we have
10 to 20% unemployment.
In this country in 1 to 5 years. So now you have this massive stability issue. You've got a safety issue and a stability issue, and within the big beautiful bill is a moratorium on AI regulation.
So no guardrails.
Oh my gosh, that is when you've just been served, and no one, see, the interesting is no one in the AI community pushes back on this, right? Because anyone that understands it and sees how it's progressing, these models are increasing 1 to 500% in their efficiency every 4 months. Understand, these are real possibilities. So
Paul, how do we get to guardrails? Because in the case of the debt bomb, right, as Gary Schilling would call it, you've got bond vigilantes to push back. In the case of the AI bomb, which we fear, there's no government that's going to regulate this because they'll lose out to another government.
Right. So I've come to this realization in the last 2 years that actually I think libertarianism is as much of a threat to our society as socialism. It's the other end of it, right? And you've really got this libertarian bent that's taken hold of this administration. So many of the biggest backers, but oh my gosh, our country's built on. I mean, we're built on a system of laws and regulations about private property rights, laws against assault, robbery, etc. So what we have to figure out in a thoughtful way, which is why you have to sit down and begin a discussion. How do we have AI for good? How do we prevent the AI for bad, both on a safety standpoint and a security standpoint? One thing that we really need to do is, again, what is the government's responsibility? What are companies' responsibility? We're going to have this productivity boom, right? Capitalism is so spectacular at maximizing productivity, but it's actually really bad in the tails, I'll say. It's really bad about distributing income in a society, in a socially beneficial fashion. The best example can be, if we look at, say, since the mid-80s, if you look and see how the productivity gains in the United States have been distributed, it's about 15% to the bottom 90 and 85% to the top 10. And so what happens when you do that? Well, you get the incredible divisiveness that we have right now. We have a crisis of trust in this country. No one knows who to trust. Hell, we had a faction of the Republican Party storm the Capitol in 2020 because they lost an election. So we're at a really socially fragile time because of wealth disparity, and now we have AI that, unless we think about how we distribute those productivity gains in a way. So is it, Dario mentioned, we're going to have a token on every time a model's used. Bill Gates said we're going to, suggested, I think 6 or 7 years ago, maybe we tax robotics. There has to be we need to sit down and thoughtfully think through how we distribute the coming productivity gains so that people are happy and not unhappy.
Paul, it's been a real pleasure having you. I appreciate you coming in, and I hope we can get you back sometime soon. Paul Tudor Jones there, co-chairman and chief investment officer of Tudor Investment, also the founder of the Robin Hood Foundation. You heard the opening bell there on the New York Stock Exchange and on the NASDAQ marketplace. In terms of the indexes right now, we're seeing some slight gains, and as Katie pointed out, we're seeing a drop in bond yields and the VIX. So a low inflation number, Katie, below expectations, a lot cooler, or at least somewhat cooler than we were anticipating, has driven us higher again in risk, and we're now at 6,050.
Yeah, it's interesting to see that it was really the inflation print that is boosting markets. There wasn't too much of a reaction to President Trump posting on Truth Social that they have the outlines of a trade framework with China. But let's take a look at some individual movers right now. A minute after the bells rang, we're keeping an eye on Tesla. That's after Elon Musk said that he regrets his back and forth with President Trump last week. Tesla also delayed its rollout of robo-taxis in Texas. You can see shares rebounding a bit right now at the opening bell, Matt, up about 2.6%.
All right, we are also watching steel stocks as the U.S. and Mexico close in on a deal that would remove those 50% tariffs that President Trump announced when he was in Pennsylvania on steel imports up to a certain level. That has brought down Cleveland-Cliffs almost 7%, Nucor 5%, commercial metals down almost 2% because, of course, they would be able to raise their prices, I guess, to almost 50% if you have those tariffs. If they're only 25%, it's going to be a lot less. Let's talk about these markets. Joining us now at the desk is Alicia Levine. She is head of investment strategy and equities at BNY Wealth. And what a fascinating setup, Alicia. Great to have you here on a day when we get even cooler inflation than we had anticipated. As Paul Tudor Jones was just saying, the bond vigilantes really don't care about the debts and deficits from the big, beautiful bill. What's your take on stocks at 6,050?
Look, I think we're ending the year higher because the pain trade obviously is stuck.
It's only June.
It's only June. Like, it can be a rocky summer. I think the CPI this morning was surprising, but if you're looking closely, you know, the core goods are moving higher and they're no longer in deflation. So core goods are moving higher, but core services are weaker, suggesting some demand destruction in the leisure and hospitality sector as households kind of come together. Altogether, I think we're all surprised. Wall Street is obviously surprised that CPI came in lighter month over month, because last month the story was, well, the tariffs really weren't on, the data reads weren't really good enough yet. Now we have the data, and every data print is better than expected. Labor market better than expected, CPI better than expected, and everybody is offsides in positioning for where we are in the U.S. markets. And so what does that mean? That means the pain trade is higher. I can't tell you how many conversations we have. Everybody's negative, like really devastatingly so. And when everybody's on one side of the boat, you know, the markets do the other
Well,
thing.
to your point on the economic data, this was the 4th straight month that you had core inflation rise less than forecast. As you said, it feels like the totality of this market is still offsides here. But the pushback to these numbers that you see in the immediate aftermath is, okay, but we're not seeing the tariff impact yet. Implying that it's coming. Alicia, is it coming?
We think it's coming. We thought we would have seen it by now, and we haven't. So I think it is coming. But then, as you're getting signs that, you know, we're going to remove the 50% tariffs on Mexico, on steel, and there's some deal going on with China, that means it's a little bit of a wait and see also on raising prices, because in the end, we have price-sensitive consumers. And the thing about the stagflationary moment that we're all afraid that we're in, and doesn't seem to be just yet, is that first you get the boost of inflation, and then you get demand destruction pretty quickly after that. It's just not happening.
Paul Tudor Jones didn't seem to buy the inflation numbers at all.
No.
Right? He said they were 2 or 3% below what the true numbers are. I wonder if his suggestion that the Trump administration is going to bring in the most dovish Fed chair possible also has some effect on this. We were reporting yesterday that Scott Bessent is in the lead, but Kevin Warsh is also a contender. What do you think about that idea, Alicia, that the Trump administration is going to be able to engineer this so that rates really are lower, even without cutting deficits?
Look, let's just go back to last September when the Fed cut 100 basis points and the 10-year moved higher. So the story here is going to be on the long end, on the 30-year, and on yields. And it's interesting because, you know, the 10-year is still sitting there in that range in the 430 to 460, despite this conversation. And, you know, if you do get a Fed chair who's going to be the most dovish to cut, it doesn't mean that the long end will be compliant with this. And I'd be shocked if it were, simply because there are too many interesting data points around inflation that, you know, that we haven't seen yet. So the story is you might engineer growth out of it, but you're certainly also going to get higher yields. And so yes, the other story, of course, is that the positioning and bonds. I mean, no one is long the long bond. Right? So that's interesting as well. Like, does
There's one guy, right?
One guy.
There was one guy that I sent you a message about overnight.
Well, you sent many messages, so I can't quite remember. But it feels like when it comes to the long bond, that could be the ultimate contrarian trade to actually step in.
Absolutely.
Would you make that trade?
Not yet.
Okay.
Not yet.
What do you need to see?
Look, I think that it's uncomfortable where the big, beautiful bill is in terms of the deficits. I think the conversations have not really, in the end, if you're going to cut the debt through lower deficits, it's going to have a growth effect. And it's very hard for any administration to make that choice. What's going to happen, I think, and this is somewhat depressing on growth going forward, is that if the U.S. does nothing about entitlements, that's where the money is. It's $4 trillion. Like, why'd you rob the bank? That's where the money is.
Yeah.
That's where the growth in deficits is coming from the out-of-control entitlements. If no administration is willing to do that, it then needs tariffs as revenue, because there's not enough tax revenue. Now, I heard what Paul Tudor Jones said about taxing the high end. You can tax the high end all you want to 90%. You're still not bringing in enough revenue to deal with the $2 trillion deficit. So you have to do, you either have to revenue raise, and that's what the tariffs are doing over 10 years, over $2 trillion. That's the problem here. Do we get stuck on tariff revenue because we can't cut, because nobody is willing to take the hit and have slower growth and maybe a recession? That's really the risk here.
He clearly wants tariffs to stay, and he clearly is counting on that revenue. I always remind people that taxes bring in $2.2 trillion taxing people, right? Corporate taxes only bring in like 500 billion, not even, because we don't tax corporations. I will say Gunit Dhingra, who is the head of New York-based head of U.S. rates at BNP, said that he sees a case for buying bonds at current levels. So there's one person out there. I gotta ask quickly, Alicia, the other side of this, which is that earnings seem to be strong, right? And we've had a number of people, including Mike Wilson, say, hey, 13% earnings growth, everyone's ignoring this.
Right, so I'd say we are not. We take policy as given. So we had lowered our earnings for next year in 2027, and then we immediately moved our earnings higher again for 2026. We actually see the S&P at 65 to 6,600 within the next 12 months. We have a price target close to 7,000 for next year because earnings are hanging in there. What the first quarter of earnings did is it kind of sterilized the rest of the year for this year. So we're probably coming in about 265 in earnings for 2025, but the market doesn't really care because it's looking at 2026. And so, by the summer, it's always the forward 12 months. And so earnings are coming in really well. The margins, specifically the margins that we're getting from the top tech stocks, the Magnificent Seven, the top 10 of the market, driving the margins higher for the S&P. There are pain points in retail. There are definitely pain points in some of the leisure stocks and airlines. But that's not what's driving the overall margin. And so in the end, the fear that these stocks were too high of a weight, and as they go, the market goes, it turns out they're not going anywhere, because their businesses are so strong, and it is the AI revolution, and you don't short, essentially, by being underexposed, one of the greatest tech, revolutions in the last 30 years. And that's what we're seeing here. So you've got to be in it. You got to be in it to win it. Alicia, that's a nice place to leave it. Great to see you. That is BNY Wealth's Alicia Levine. I will say, on the other side, so you have BNP basically betting against the steepener. Paul Tudor Jones, I wasn't expecting to get right to the yield curve steepener, but
I was hoping for a stock pick, but he said he's not really into individual stocks.
No, he's looking at the yield curve. In any case, let's talk about some individual stocks, specifically quantum computing stocks. They're in focus at the open. That's after NVIDIA CEO Jensen Huang said the industry was at an inflection point. Huang was speaking at GTC in Paris to kick off France's Viva Tech conference.
It's very clear now that over the next several years, or at least the next generation of supercomputers, every single one of them will have a QPU assigned and QPU connected to GPUs. The QPU will do quantum computing, of course, and the GPUs would be used for pre-processing, for control, for error correction, which will be intensely computationally intensive, post-processing and such.
Now, if you're getting whiplash, that's because that's a stark difference from just in January when Huang said that quantum computing is decades away. Let's stay on those comments, because for more, we're joined now by Bloomberg Tech co-host Caroline Hyde. So, Caroline, why the change of heart from Jensen Huang?
He can sell some chips. Maybe as an answer.
That helps.
It's interesting. We've got to walk back on that time frame. Actually, a little bit earlier in the year when they hosted their first Quantum Day, they're realizing that being able to foster supercomputing using quantum is going to be a real driver of growth. You can make AI, generative AI, so much more powerful with the use of quantum computers. They're able to solve problems so much faster than the best supercomputer that's currently out there with current GPUs. And so I think at the moment he's seeing an opportunity to galvanize demand, and he's seeing breakthroughs. Look, we've just had IBM, local New York player, saying that in Poughkeepsie, just a couple of hours north of here, they're going to be building a quantum and error-correcting quantum supercomputer by 2025. 29. So within the end of this decade, they're going to be making leaps and bounds move forward. They think it's basically just an engineering issue to make sure that you're getting this correction, the errors that are built into what are very volatile qubits that are used within quantum. They think they can solve for it. You've had breakthroughs from the Willow chip over at Alphabet. You've had Ocelot over at Amazon. And I think finally we're starting to see what he now gains as an inflection point.
Yeah, Willow, he poo-pooed Willow, right? He was like, come on, this isn't going to happen for like 15 years. Now it's going to happen like next year?
Well, I think he's seeing the desire and the money from these players, and the race is on, and they can use his infrastructure once again to be able to galvanize this growth. I think you're also seeing some of the individual stocks raised on the back of this. There are different ways to be solving the quantum computing outlook, whether or not you're using algorithm, whether you're using what's known as a gate measure and use case, which is what more IBM is stacking themselves upon. But I think that we are going to see this hope, because at the moment it is so compute intensive for generative AI. It is so energy intensive. People need to see these sorts of breakthroughs if we're going to use the sort of, well, the hopes and what Paul Tudor Jones was just telling you, this breakthrough in generative AI, it needs to compute. Maybe we could see that from quantum.
Absolutely, and we're certainly seeing quantum stocks rise today on the heels of these comments. Caroline Hyde, great rundown as always. That is Bloomberg Tech co-host Caroline Hyde. You can catch her at 11, but coming up on this program, Elon Musk has regrets. The billionaire says that he went, quote, too far about with his comments about President Trump. We'll give you the details next. This is Open Interest.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back to Open Interest. It's time now for top calls, some of the analyst action in focus this morning. And first up, J.M. Smucker actually getting upgraded to a buy over at Jefferies. The firm says that the pullback after the company's earnings release yesterday was overdone. Remember, it fell by nearly 16% yesterday, now up 1.7%. Next up, we have Urban Outfitters getting raised to a buy over at Baird after the retailer's investment day. The Baird analyst says that the reinforced a durable growth strategy. And finally, we have Stifel. It started coverage of Uber with a buy rating. The firm is bullish on Uber's advertising opportunity. You can see Uber shares pretty much unchanged, Matt Miller.
All right, let's get into Elon Musk. He is crawling back, trying to mend his relationship with President Trump, posting on X that he regrets some of the posts he made back on June 6th. And indeed, he deleted some of the key tweets. Joining us now for all things Elon Musk is Max Chafkin. Been covering the billionaire for a while, and you also host Elon Inc.
This walk back, it started almost immediately.
It's so painful.
I don't think he had any other choice. I think given where Elon Musk is, given how dependent his companies are on a good relationship with the U.S. government, and given the fact that he spent basically the last year alienating a huge chunk of his customer base by throwing his weight, political weight, entirely behind Donald Trump, I don't think he really had anywhere to go. You can't make everybody mad and still sell a lot of consumer products.
He still has $370 billion. He's the richest man in the world by over $120 billion. Like, who cares?
He's trying to go to Mars.
Stand your ground, man.
He wants to go to Mars, and that takes a lot of money. But let's talk a little bit about how dependent his companies are. I think we have a 7-day chart of Tesla, and you can really see the bite that was taken out of Tesla shares and the recovery. There it is. So it seems like, at least the market was voting and saying, we want you to make good with Donald Trump.
I mean, the market saw this walk back coming. It's funny, I believe it was on Friday, a random person on Twitter, a person with like 200 followers, said, hey, you guys should cool down. And Elon Musk said, yeah, that might be a good idea. And that was kind of the beginning of this slow walk back. You saw the deleted tweets, and now this. I think he's probably going to have to go further if he really wants to be welcomed back, into the Trump fold, either by making a donation or by making, some further full-throated support for Trump. We've seen this happen with other Trump world figures. Remember that J.D. Vance said some very critical things of Donald Trump before he became Donald Trump's vice presidential pick. The price is just going to be, I think, full-throated support, probably some campaign content.
I'm going to take the other side. I think Elon Musk is a lot stronger than he thinks. Not only does he have so much wealth personally, Tesla is worth over $1 trillion. It doesn't matter if you sell cars, right? He only sells 2 million cars a year, so that's not a car-making valuation. And he could decommission Dragon, on which the U.S. is pretty reliant. Why doesn't he stand up?
I feel like that stock chart you just put up tells a story. I mean, so much of his net worth is tied up in a kind of meme stocky slash, faith in Elon Musk's ability to transform his ideas into actual products. The actual products, as you say, aren't quite there yet. And so this is a lot of bet on the future. How does that bet on the future change if you are kind of persona non grata with the most powerful person on earth, if you've alienated your customers? I think there are real risks here. It's true that he's in a strong position.
And he's young.
But so much of his, as he said, he's going to be around for 40 more years. But so much of his net worth is tied up in basically Tesla stock and in the stock of these privately held companies like SpaceX.
All right, yeah, I wish that SpaceX was public because, boy, that would have been a very fun 7-day chart. Max Chafkin, a very busy man at this moment. That is Bloomberg's Max Chafkin. He covers all things Elon Musk for Bloomberg News. Meanwhile, let's take a look at some other stock movers that are on our radar today. And we start with Victoria's Secret. Profit estimates for this quarter disappointed as tariffs eat into gross margins. We've certainly heard that before, but you can see that shares actually rebounding a little bit, managing to find their way into the green. I really want to talk about Chewy because look at that, more than decimated on Chewy shares right now.
They make dog toys.
They make a lot of things. You know, you can get all manner of pet care items from Chewy. Their profit estimates, though, they also failed to impress. Demand remains resilient. I've bought turtle food from Chewy in addition to cat litter, and they do have horse items.
Here's
as
the
well.
thing. If you were completely destitute and had nothing left, would you still scrape together enough money to buy Catrick his meals?
Yes,
Yeah.
absolutely.
Of course you would. Chewy's worth $17 billion. GameStop sales, and by the way, there's a relationship between the two, right? Because Ryan Cohen, who started Chewy, also, at least for a while, ran GameStop, missed sales estimates. The firm leans into collectibles, which climbed by 50% in the past year, but investors are not impressed, and the stock is down 4%.
This is Bloomberg.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
The easiest long-term trades are, you know the yield curve's going to steepen, probably to historic wides. You know we're going to cut short-term rates dramatically in the next year. And you know the dollar will probably be lower because of that.
Billionaire investor Paul Tudor Jones speaking earlier to Katie and me right here on Open Interest. Pretty great conversation.
It was really interesting. Again, we marveled at the fact that he went straight to the yield curve, wasn't necessarily expecting that. We also had a very interesting conversation about potential Fed chair picks. Remember that Jerome Powell's term ends in May 2026. And interestingly enough, we just got a Truth Social from President Donald Trump saying that CPI just out, great numbers. Fed should lower 1 full point, would pay much less interest on debt coming due. So important. You could have put money on that we were going to get a
Well, we knew J.D. Vance earlier in a tweet replying to our own Joe Weisenthal, the Odd Lots podcast, saying that this is monetary malpractice, the failure to lower rates. In terms of what we have coming up, I will tell you that the Treasury Secretary, Scott Bessent, he is set to testify before the House Ways and Means Committee, and we're going to bring you those remarks because right now, anything Scott Bessent says after he's come back from London, where he was talking with his Chinese counterparts, is very important to this market. We bring that to you next. This is Bloomberg.
another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. President Trump says the U.S. and China have reached a trade agreement. Commerce Secretary Howard Lutnick.
I think what happens is when you put President Xi and President Trump on the phone together, it changes the outcome.
Correspondent Ed O'Keefe has details from the White House.
U.S. tariffs on Chinese goods will be 55%, while Chinese tariffs on American products will be set at 10%. White House aides tell us this morning those levels are what they are for now, but could change again. The president also says necessary rare earth materials, which have been a major point of contention, will be exported up front by China. And among the things Beijing gets in return are assurances that Chinese students can keep attending American colleges and universities.
President Trump says the deal is subject to final approval from Xi Jinping. Inflation was up 0.1% in May, month over month. That's a little less than economists expected. It puts the annual inflation rate at 2.4%. Business analyst Jill Schlesinger on what's driving the numbers.
Meat, poultry, fish, and eggs, your favorite proteins, were down 0.4% month over month. But eggs are still up 41.5% from a year ago. Those prices should start to moderate.
Cities across the country are bracing for new anti-immigration raid protests after a new curfew brought quiet to downtown Los Angeles as U.S. Marines arrived on orders from President Trump. Mayor Karen Bass spoke to KNX.
The president said he was going to leave the military here until everything was peaceful. Well, hopefully the military will leave by the weekend.
Demonstrations have spread to Denver, Chicago, New York, and Austin. Texas Governor Greg Abbott has ordered the National Guard to San Antonio in anticipation of protests there. Survivors and loved ones who lost family members at the Pulse nightclub massacre in Orlando 9 years ago are finally getting a chance to walk through the venue before it's razed this week and replaced with a memorial. Christine Leonin lost her son Christopher in the shooting.
My son didn't die running out of the building or die at the hospital. My son literally died on that dance floor.
A jelly and coffee giant, the latest company to warn tariffs are hurting the bottom line.
The best part of waking up is Folgers in your cup.
Shares of J.M. Smucker plunged 15% yesterday after the maker of Folgers Coffee, Jif Peanut Butter, and Smucker's Jellies announced its profit for the current fiscal year will fall short of estimates because of increased tariff costs in its coffee business.
CBS's Michael Wallace reporting the Dow's up 49 points. This is CBS News. An entertainment giant plans to break ground on some new concert sites.
Live Nation says it's building 18 new concert venues across the country, everything from small clubs to large outdoor amphitheaters. The company says they'll open over the next year and a half at a cost of $1 billion. Live Nation already has 150 venues. The new projects are built as a way to reach smaller markets. Places like Allentown, Pennsylvania, and Virginia Beach are on the list. But so are larger cities like Atlanta, Denver, and Seattle. Steve Kathan, CBS News.
It's the first post-Tony Awards casualty.
Smash is the hilarious new musical about the making of a musical about the life of Marilyn Monroe.
Just a month after it opened, Smash, whose executive producers include Steven Spielberg, is closing. It was shut out at Sunday's show and struggled at the box office. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
Are people just too exuberant out there?
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. You're listening to the Bloomberg Intelligence program. Alex Steele, after co-hosting with me for Surveillance this morning. She's out, sitting in for Alex for the next 2 hours. Too much of me. She's had enough. 3 hours is max. Isabel Lee, though, Bloomberg News reporter, is joining us for the next couple hours. All right, here's the game plan, folks. Treasury Secretary Scott Bessent, he's going to testify before the House Ways and Means Committee. We're going to carry that live when Mr. Bessent's opening remarks begin. That should be in a matter of moments. We're also going to check in with Michael McKee. We had some economic data. Inflation out there, folks, came in better than expected. If we're expecting tariff-related inflation, not seeing it yet. So we'll talk to Mike McKee about that. But let's kick things off here and get a sense of what's happening in the markets. A Bloomberg Business Flash with John Tucker.
All right, we'll keep this one short. This Bloomberg Business Flash being brought to you by IBKR. Will U.S. oil production exceed 13.4 million barrels per day for April 2025 at IBKR Forecast Trader? The S was recently at 39%. You can start predicting today at ibkr.com/forecast. And the last trading day for this contract is June 29th. As you say, Paul, companies so far seem to be holding back on passing higher tariff costs to consumers. The underlying inflation in the U.S. rose in May by less than forecast for the fourth month in a row, up just 0.1%. So that's also increased bets on more than one Fed interest rate cut this year, and yields are lower as a result. The more policy reactive 2-year, that is down just about 5 basis points. We're at 3.96. The 10-year, 2 basis points lower, and that is at 4.44. Well, President Trump also said a trade framework with China has been completed. Right now, you had 8 of the 11 major industry groups in the S&P 500 higher, led by consumer discretionary. That's home to Tesla. And the S&P 500 just 6 points higher, up 0.1%, 6,044 on the index. The Dow Jones Industrial Average 44 points higher. That is up 0.1%. The Nasdaq 100 right now 22 points higher. That is up 0.1%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Isabel and Paul.
All right, John Tucker, thank you so much. We appreciate that. Isabel Lee sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we are streaming live on YouTube as well. As John just mentioned, we got a little bit of a lift to the market, but let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Isabel Lee, and we're joined by Bloomberg's Christine Aquino. Christine, what are you looking at?
Well, let's take a look at Tesla, Paul, because that's doing pretty well today. They're pairing some of those earlier opening gains. Ticker TSLA just up now over 1%, 1.6% at the moment. That was up earlier, 2%. But basically, this is Elon Musk showing some signs of regret. He was posting on X saying that some of his posts about President Donald Trump last week were regrettable. Remember, they traded barbs, right, over the Republicans' tax bill. Elon Musk criticized that, and of course, President Trump was not happy about that. And so Dan Ives from Wedbush weighing in, calling it an important step. And given that the timing of the argument was not ideal because Tesla is about to launch its robotaxi in Austin. So seeing a bit of recovery in those shares there today.
What about Lockheed Martin? Shares are sliding. Why is that?
Yeah, exactly, Isabel. We're seeing those losses extending actually now down more than 5%. So that's Lockheed Martin, ticker LMT. And that is because the Air Force cut its request for signature F-35s in half. It's now down to a request for 24 planes from a forecast of 48 last year. And remember, Lockheed is the top U.S. defense contractor, and the Air Force is their largest customer. So this, of course, probably reflects the efforts to comply with Defense Secretary Pete Hegseth's plan to reduce projected military spending by over 8% in the next 5 years.
All right, what else are you looking at?
Looking at First Solar today, those shares having a good time. That's up now more than 3%. So First Solar, ticker FSLR. And that is because Jefferies raised its recommendation for the stock. It is now a buy from hold previously. And analysts are pointing to speculation that Congress may support parts of the Inflation Reduction Act, which the company benefits from as a solar tech company. And Bloomberg Intelligence analysts also saying that the Senate will probably moderate some of the House's provisions for the Inflation Reduction Act part of the bill, and they see an 80% chance that a deal gets done before the August recess.
All right, Christine Aquino, thank you so much. We appreciate that. Christine Aquino, Bloomberg Equities reporter. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest movers and the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcast, Spotify, or anywhere you listen. EcoGo, we were paying attention to that around 8:30 this morning. We got CPI data that came in, I'm going to say noticeably kind of below forecasts, and I think a positive surprise for a lot of folks out there. Certainly if you look at the short end of the market, the yields are in about 5 basis points at 3.97%, but what do we know? Michael McKee does this stuff for a living, does all the economics for Bloomberg here. He joins us here in our Bloomberg Interactive Broker Studio. Mike, what'd you make of this? Again, a little bit better than expected on the inflation front. What's happening here?
Let me quote our good friend Stephen Stanley up at Santander, who said the May CPI was shockingly benign.
Okay, exactly.
We don't know exactly why, but a lot of things that people thought would go up in price because of tariffs did not go up in price. We saw a decline in used and new car prices, although used car prices not as much of a surprise, but the new car prices, we heard announcements from Ford and others that we were going to see some price increases, and we didn't see apparel go up. Apparel prices, imports apparently did not contribute tariff issues. The story may be that remember, we imported a lot of stuff in January and February, and so it's very possible that retailers were selling out of inventory, and so they didn't have to raise prices yet. Also, some of the bigger companies that we keep an eye on, like Walmart, said they were going to start raising prices, but not until the end of May. So wait for the June numbers. If we get another benign CPI report in June, then maybe tariffs aren't going to be so bad. but it's too early to say all clear. It's too early to tweet, as the president just did, that the Fed should be cutting rates by a full percentage point.
To your point, it's really the well-stocked inventories that may have been the reason why retailers haven't passed on the cost to consumers just yet. But not one of the 73 forecasters in Bloomberg's survey penciled a 0.1% increase in core CPI. What do you think they missed?
They missed a lot of different little areas. Airfares were down, but more than anticipated. Lodging was down. Gasoline prices were down. Now, gasoline prices, when we look at the gasoline prices on the Bloomberg, we're usually looking at the AAA daily price. And while that was down about 1%, the BLS seasonally adjusts the gasoline prices, and so that was down 2.8%. So that contributed a lot to taking off some of the headline prices. So a lot of different things went up and down that were somewhat individual, but or idiosyncratic. But again, it's hard to put a true read on everything. It is also possible that companies, because they were uncertain about the tariff effects, were holding off on price increases and just taking it out of their margins for now, because they didn't want to drive away customers if the tariffs were going to kind of go away.
Still, when you think about China, all the stuff we bring in from China, 50% is a big number. I mean, a big number that nobody would even think about before. Well, how does that factor in? I mean, I guess that's a going forward thing, back half of the year kind of thing.
Yeah, I mean, we've had a lot of tariffs on China already, which is why you get to that 55%, because they forgot about the 25% that he had put on in his first term that's still there. So people are used to paying some of those prices. The biggest thing is that that's an average of what a weighted average of what the tariff is going to be. So it'll depend on the product. And as you say, we import a lot of things from China, but there's also a lot of efforts to get around that by transshipping and stuff like that. So it may not be that high. The biggest impact is probably going to be on the de minimis exemption that the president's getting rid of, because all the small companies out there, small retailers who bring in the cheap stuff from China and sell it, they're going to have to pay a lot more than they were. And that'll start to impact businesses and have an effect overall on the economy. But we are still waiting for the rest of his world tariffs, and that will have an impact as well. So we're really no better off than we were.
So the only way we would not see inflation resulting from tariffs is if every company decided to just take it in their margin. Is that kind of not to pass along price increases?
Yeah, or if they were able to convince the sourcing country to cut their prices, which, you know, all of this will happen. Some sourcing companies will cut prices. Some retailers will trim their margins. But some people like us will pay. will pay more money. And, you know, the president's been bragging about how much tariff income has come in, tariff revenue has come into the country. Who paid that? We did. You know, so basically what you've got is the big beautiful bill cutting your taxes at one side and then the tariffs raising your taxes at another. So it's trading one tax regime for another tax cut.
It's also hard to ignore who the next Fed chair would be. And we earlier had Paul Tudor Jones, a billionaire investor, saying that Trump will likely appoint a, quote, uber dovish Fed chair to accommodate his growth agenda. What are your thoughts on that?
I think the president would love to appoint somebody who's uber dovish, but just because he doesn't mean he's going to get what he wants. There are 19 members on the Open Market Committee, 12 of whom who vote. Only one of them is the chair. And there are only going to be 2 openings between now and 2028, when Trump is in his very last year, unless somebody resigns or something happens to someone. And so the culture at the Fed is very strong, and it is very based around the idea we don't let inflation get out of control. So I don't think that you're going to have anybody come in and immediately we're going to be betting on a full percentage point rate cut. They're going to be pretty much the way they have been. We don't really know what Scott Bessent thinks. about whether, you should be cutting a lot or not right now. I can tell you Kevin Warsh, the other favorite for the job, has always been a hawk. So I'm not sure that the president will get what he wants out of all this. And both Warsh and Bessent have said privately that whoever the next Fed chair is going to have to prove themselves to Wall Street. If they come in saying I'm uber dovish and I'm going to cut rates because Donald Trump wants me to, that's going to provoke a really bad reaction in the bond market.
Producer price numbers tomorrow. I usually put that on the back burner versus CPI, but I'm being told by some smart people that we need to really pay attention to producer price index tomorrow. Yes. Why is that?
Your producer needs to book me for tomorrow.
Okay.
Because the producer price index doesn't have a direct correlation to the CPI, but basically it gives you the direction of where the CPI will be in a couple of months, because it takes a while through the middlemen, et cetera, to get to consumer prices. But we're likely to see intermediate goods prices, metals prices, things like that didn't have a huge impact on this month's CPI, go up in the PPI and sort of flag that we're going to see these prices rise ahead. If that doesn't happen, then you almost have a more benign outcome than you had today, because then there isn't seen as inflation pressure in the pipeline.
And as we wait for the 90-day tariff pause to pass, markets will be caught between inflation and the jobs print. If inflation stays under control or the job market weakens, the Fed will likely cut. Are your sources telling you which is having more influence than the other? Are they watching one more data point?
No, they're watching both. The anticipation was that we might see inflation go up faster because companies are going to just, pass price increases through. The question is, with inflation, is it a one-time price increase, or does it just keep going month after month? And ordinarily, the history of tariffs has been it's a one-time kind of thing, but the way Trump is managing it, it could spread out over the year. It'll take longer for unemployment to rise because companies went through this horrible period coming out of the pandemic where they couldn't find anybody to hire, and they're going to hold on to their labor force as long as they can afford to do so. So the Fed is kind of keeping the closest eye on inflation.
Michael McKee, thank you so much for joining us. Michael McKee does all the economics for Bloomberg Television and Radio. We appreciate getting his thoughts. Right now, U.S. Treasury Secretary Scott Bessent, he's testifying before the House Ways and Means Committee in Washington, D.C. Let's go to that right now.
And strengthen the economy. We look forward to coordinating with you on the President's budget, his tax priorities in the coming weeks. As part of this effort, I wish to highlight today the Treasury Department's efforts to advance President Trump's economic agenda on tax and trade. First, tax. I'm pleased to report the Treasury has just completed its most successful tax filing season in years, and we did so while improving efficiencies and cutting costs at the IRS. Critics of the President's efforts to modernize the IRS warned that the effort would result in a 10% shortfall in receipts. Instead, the opposite happened. April receipts this year were up 9.5% over the previous year, and receipts in May were up 14.7% over the previous year. Most remarkably, the President was able to achieve these results while reducing $2 billion in waste and planned IT spending at the IRS. This success has taken place against the backdrop of one of the most consequential tax proposals ever to come before Congress, the One Big Beautiful Bill Act, or as I will call it today, OBBB. The One Big Beautiful Bill will make the 2017 tax cuts permanent. This will provide individuals and businesses with certainty and build economic momentum. The legislation is squarely aimed at boosting the working and middle class and reinvigorating American manufacturing. According to the Council of Economic Advisors, the One Big Beautiful Bill will raise take-home pay between $7,800 and $13,300 for the average family of four. It will increase wages between $6,100 to $11,600 for the average worker, and it will cement no tax on tips, no tax on overtime, and tax cuts for seniors. The One Big Beautiful Bill will also incentivize unprecedented investment in U.S. manufacturing. The legislation will provide 100% expensing for new factories, as well as existing factories that expand operations and support Made in America. It will streamline burdensome permitting processes that often stand in the way of new manufacturing projects. It's time for this country to start building things again, and the OBBB makes this possible. The administration is grateful for the leadership of this committee in shepherding the One Big Beautiful Bill through the House. We are working closely with members of the Senate to get this legislation to the President's desk. Trade is the second topic I wish to highlight. The progress we have made on tax issues over the last 4 months complements the significant progress we have made in rebalancing the global economy. Since I last testified before Congress in May, the President announced a historic U.S.-UK trade deal. This arrangement, which creates a $5 billion export opportunity for American ranchers, farmers, and manufacturers, is a preview of what's to come. Dozens of countries have engaged the administration thus far with offers to improve their trade relations with the United States. This includes China. I have just returned in the middle of last night from successful negotiations in London with a Chinese delegation that will not only stabilize the economic relationship between our two economies, but make it more balanced. China has a singular opportunity to stabilize its economy by shifting away from excess production towards greater consumption. But the country needs to be a reliable partner in trade negotiations. If China will course correct by upholding its end of the initial trade agreement we outlined in Geneva, and I believe after our talks in London they will, then the rebalancing of the world's two largest economies is possible. By challenging the decades-old status quo on tax and trade, President Trump is breathing new life into the American economy. More than 500,000 private sector payroll jobs have been added since January. Most importantly, inflation in the U.S. is at its slowest pace since 2021, and the numbers we received today take us back to the slowest pace since 2020. Most importantly, we are decelerating cost increases for shelter, food, and energy. After 4 years of price increases diminishing the U.S. standard of living, inflation is showing substantial improvement due to the administration's policies. Furthermore, the labor market remains strong with low unemployment and plentiful labor demand as job openings remain high. This strength has been exemplified in the recent performance of the stock market and consumer confidence data. The President's bold leadership on these issues has laid the ground for a golden age economy. With your help, we can build on that foundation to create even more prosperity and abundance for the American people. We hope you will join us in this endeavor. Thank you all, and I look forward to your questions.
Thank you. We'll now proceed to the question and answer session. One of the more absurd attacks we hear from our Democrat colleagues is that the one big beautiful bill is focused on the wealthy, not the working class. I'm sure the waitress who will keep more of her hard-earned money under the no tax on tips policy, or the lineman burning the midnight oil to restore power and seeing a tax cut under the no tax on overtime policy would be surprised to learn that Democrats consider them wealthy. Secretary Bessent, whether it is those policies or the tax relief in the bill for seniors, the double child tax credit and standard deduction, or the fact that the tax burden on the truly wealthy will actually rise under this bill, how does the one big beautiful bill deliver primarily for working families?
Thank you for that question, Chairman Smith. As we saw in President Trump's first term, substantial non-inflationary growth was created. Non-inflationary growth. Real wages rose, and working Americans did better. Hourly workers did better than supervisory workers. We believe that this will happen again. As you outlined, no tax on tips, no tax on overtime, tax breaks for seniors on Social Security, and the ability to deduct auto loans on new cars made in America, as was available when I bought my first car in 1978, will be restored. All of this will help working Americans overcome this horrendous affordability crisis that this administration inherited.
The Biden administration negotiated a global tax scheme through the Organization for Economic Cooperation and Development that would rob American taxpayers of $120 billion and would discriminate against American businesses. President Trump issued a day one executive order opposing the Biden administration's global tax surrender. In the One Big Beautiful Bill, Congress provides the president, in line with that directive, specific targeted authorities to fight back in the event nations impose a discriminatory tax on American businesses, such as a UTPR. Last week, members of this committee met with an ambassador who was specifically concerned about how this provision would give the U.S. the ability to stand up for American businesses and respond to an unfair tax his country has imposed on American job creators. Secretary Bessent, why is it important for the Treasury Department and the President to have strong protective measures like the one provided in the One Big Beautiful Bill to fight against foreign taxes that discriminate against American companies? And how will the administration ensure that the use is targeted and in a manner to protect or replace U.S. tax revenue?
Mr. Chairman, for whatever reason, the previous administration chose to outsource American sovereignty on tax matters, and the Trump administration believes that is unacceptable. Unacceptable. Many other countries would seek to pull in revenues from U.S. multinational corporations into their treasuries. And rest assured that the provisions in the One Big Beautiful Bill to combat this are a staking out of our fiscal sovereignty. The U.S. tax system will stand next to what is called Pillar 2, and other countries are welcome to relinquish their fiscal and tax sovereignty to other nations. The United States will not. So this bill will allow us to prevent our corporate revenues from being drained into foreign treasuries, and that is in the hundreds of billions of dollars.
Thank you, Secretary. President Trump is also using tariffs to level the playing field and demand fair treatment for American workers, farmers, and manufacturers. Secretary, you are on the front lines of the president's economic policy agenda, including through your lead role in trade negotiations to demand fair treatment from China over the last couple days. How do the president's trade policies and tariffs and the total reset of our unfair trade and investment relationship with China that President Trump has led fit into the broader effort to reorient America's economy toward one that serves the working class instead of just the wealthy elites?
Mr. Chairman, China currently has the most imbalanced economy in the history of the world. They now have an approximate 30% share of global manufacturing, and they continually grow their manufacturing base. They are in the midst of a real estate downturn. Some may cause a crisis, and they are trying to export their way out of it rather than take domestic measures such as increasing consumption, dealing with banking problems, or dealing with the real estate crisis. They cannot be allowed to export their way back to prosperity, which would mean substantial decreases in the standards of living, not only for the United States working Americans, but for working citizens across the world. Our negotiations with all countries seek to bring fairness. And I will echo President Trump's remarks. There are 18 important trading partners that we are in fulsome negotiations with. Many of them are coming to us with unimaginably good trade deals to bring down tariffs, non-tariff trade barriers, which the academic research has shown to can be even more pernicious than the tariffs, currency manipulation, and the subsidy of labor and industry. But as these countries come to us, and I look at the list, and I think, how could this have happened? How could this have happened? That the United States willingly became party to such unfair and unbalanced trade. And as President Trump has said, I don't blame the other countries. If you could get away with it, you should. It was those sitting behind the Resolute desk or those making trade policy who've allowed this to happen over 40 years. And we are determined to rebalance that for the American people.
Thank you, Secretary. I now recognize the ranking member for any questions he might have.
Thank you, Chairman. So maybe we could stick to a couple of facts here, as previously discussed, and that is that if you made $1 million,
listen to Richard Neal, Democrat from Massachusetts,
$84,000 in tax relief with this bill. If you made under $50,000, you are likely to get about $1 a day. The President said that we'd have 90 trade agreements in 90 days. We're 89 short because of the manner in which some of these allies have been offended. We want trade balance for sure, but we also want to make sure that it's done in a manner that will last, not subject to the whims of the administration. I understand, Mr. Secretary, that you don't agree with some of the economic forecasts that have been projected as it relates to the big, beautiful bill. So Penn Wharton says this bill will add trillions of dollars to the national debt. The Yale Budget Lab says this will add trillions of dollars to the national debt. Well, we're 0 for 2. But how about Maya McGinnis? Not exactly known for their socialist leanings. They say this will add trillions of dollars to the national debt. Well, let's go to the Tax Foundation, hardly a left-leaning political organization. They say this will add trillions of dollars to the national debt because the money's going to be borrowed. Here, facts should matter. The advice of experts should matter. We have seen the bond market's reaction to some of these proposals. They're jittery. But you know what? In this committee, we listen. The administration is putting its head in the sand on this debt issue. The facts are going to be hard to escape. So let me turn to the impact of budget reconciliation as it relates to health care. In addition to adding trillions to the U.S. debt, the bill will cause 16 million Americans to lose part or all of their health insurance, according to CBO. We know what the consequence will be of losing health insurance for the American family. More visits to the emergency room, more postponed treatments, more bankruptcies that will come because of it. The problems that people have with health insurance only mean that later on the problems pile up. Bad health, the challenge that is now going to occur for our rural hospitals, surely many of which will be forced to close. Cutting more than $1.5 trillion from Medicaid, Medicare, and the Affordable Care Act certainly will mean job losses. No industry can sustain $1.5 trillion in cuts while we borrow money for a big tax cut that, despite what has been said here today, still favors people overwhelmingly at the top. Let me say, in regard to the testimony, Mr. Secretary, that you've offered, there's another key consideration here. You're suggesting that the improvements at the IRS have all taken place in the last 6 months? It's because of what we did with the Inflation Reduction Act. That's why the improvements have taken place, the technological upgrades that have taken place as well. We have a pretty good understanding of this. We want to use artificial intelligence for better tax collections. But all of this just happened in the last 6 months. That's our understanding based upon the testimony. The Commonwealth Fund, cuts to Medicaid and SNAP are going to lead to the loss of over 1 million jobs. The American Hospital Association estimates that tens of thousands of hospital jobs will be lost as a result of these cuts. Furthermore, a professor at Yale has said that this will conservatively cause tens of thousands of unnecessary deaths. Worse health care, job losses, more borrowed money. The American people deserve considerably better than what we're being told. But let me offer this challenge, Mr. Secretary. We would be prepared on the minority side to work with the administration and direct tax relief back to people under $400,000 of joint income, as opposed to the suggestion that is being offered here today. And if you disagree with the number that I offered about tax relief for somebody who made $1 million last year, let me give you the last 30 seconds to speak to that.
Representative Neal, I have great respect for you. We've had good conversations, but respectfully, if I weigh 1,000 pounds and you weigh 50, and I gain 10 pounds, or I gain 10%, I have gained 100,000. That during President Trump's first tax cuts, the share of taxes paid by the high end of taxpayers, increased by more than 7%. And I'm sorry, I chuckled when you talked about the IT at the IRS. The program is 35 years behind schedule, 35 years, and is wasting $2 billion a year.
That's why we put the extra money in, Mr. Secretary.
No. The extra money went in for bodies, and whistleblowers acknowledged that standards were being lowered to bring in new agents. The money is not the issue here. It is how the money is spent.
That's exactly right. We agree on that, how the money is spent. And the last point that I would make...
It has been spent poorly.
Let me make this last point, Mr. Secretary. Do you agree with the idea that in 2017, that the federal government, emanating from this committee, borrowed $2.3 trillion for that tax cut?
What the belief is that everyone on the Democratic side voted for the biggest blowout for the deficit in history, and that we are suffering from that. This past tax year, we will have between a 6.5 and 6.7% deficit, so I find it very difficult to be lectured to by people who created the largest deficit in history when we were not at war and not in a recession.
So I negotiated with Secretary Mnuchin the pandemic relief bill. If that's the reference point, that's where overwhelmingly the money went. That was not a bad infusion of money. It worked. The Economist magazine and the Financial Times said in January the American economy was the envy of the world. I yield back my time, Mr. Chairman.
The spending was not the envy of the world.
I'm pleased to recognize the Vice Chairman of the committee, Mr. Buchanan.
Mr. Secretary, thank you for being here today. There's no doubt that your knowledge of finance and global markets brings.
We're listening to Vern Buchanan, Republican, a member from Florida.
This country is fortunate to have your leadership. Since coming to Congress, I've seen administrations from both parties, I'll say that up front, in terms of what's happened with the debt deficit. I want to get your perspective. I mean, the reality is, last 20 years, over $20 trillion in additional debt. I remember in the 80s, frankly, where we had the junk bond markets. I look at all these younger people out here, what we're leaving them is deplorable. And I just want to make sure that we're giving as much consideration as we can to that. 49 out of 50 governors have to balance the budget. It's my biggest issue up here. It's not about one party or the other. It's both parties have done little or nothing in this area, and it needs to get addressed. When you spend last year, you take in $5 trillion, spend $7 trillion, and you average over $1 trillion a year for over the last 20 years. We need to get real about it, because again, in the 70s, in the 80s, all the junk bond, I seen what happened with all the markets and all that. So can you make, I know you touched on it, but could you, and we'll get into the pro-growth things in a minute, can you just touch on it, your thoughts about where we're at and where we're going as it relates to that? I know we've got people looking at making cuts, but I do want to get your perspective on that.
Congressman, I've enjoyed our conversations in the past. You, as a very successful private businessman, understand the power of this tax bill, especially in the expensing. You and I discussed it in great detail. And look, we do not have a revenue problem. We have a spending problem. We are right in line with the long-term revenues of approximately 17 to 18% of GDP. What we've seen here is a blowout in the spending. And as I was saying, last fiscal year was something we have never seen before. We have never seen a deficit to GDP this large when we were not at war, or not in a recession, or not in a pandemic.
Yeah,
But
Mr.
we could call that
Secretary,
a war.
we only have 5
And-
minutes. Let me just mention just real quickly. You mentioned, and I just want to get this in, that 100% expensing is like jet fuel. And 199 is huge. These are huge opportunities to make a big difference for small business. But to me, it's because I'm so passionate about it, because they're the job creators. So can you comment on that, your thoughts in terms of 199A and 100% expensing?
Congressman, I'll very quickly comment on two things. It is the 100% expensing that is powerful, and we are adding not only expensing for equipment, as in President Trump's first term, we are adding 100% for factory structures. So if you want to build your factory here in the U.S., we want it to be tax efficient. We want you to have regulatory certainty. We want you to have quick permitting, and that is likely the single most powerful aspect. As the ranking member discussed, on the 400,000 level, that unfortunately is a disaster for small business in the 199. Most small businesses are pass-through entities, and those small businesses are substantially above that 400,000 threshold.
Yeah, let me just add just a closing point. I do want to make on the whole thing of full expensing, it's probably the most powerful tool, whether you're buying or selling. Someone that's been in business for 40 years or so, I can tell you firsthand, it's a powerful tool. It's a job-creating tool. I did want to have you comment the other thing on making, I'd say in Florida, I was chairman of the Florida Chamber, one of the big issues there is about making the tax, whatever we do on taxes, making it permanent, so they got more certainty, they can do planning and investing in terms of going forward. Do you want to add anything to that?
Yes, sir. I was with a group of business leaders earlier this week, and they were telling me that they are, in fact, holding back on CapEx because they need for the tax bill to pass so that they will have certainty that the 100% expensing will come back. I think that we will see a sharp upward break in terms of CapEx as soon as we pass the One Big Beautiful Bill.
Thank you, and thanks for your leadership. We're excited you're here today.
Thank you.
Thank you, Mr. Doggett.
Thank you. If beauty is in the eye of the beholder,
We're now listening
certainly
to Representative Lloyd Doggett, Texas Democrat.
Cabinet are so enthusiastic about this beautiful bill. It gives so much to those at the top, and of course Trump appointees are not just in the top 1%, but the top 1,000th of 1%. I applaud your personal success, but isn't it true that for you and for a number of cabinet members and other Trump appointees, simply not having your taxes restored to the level that existed when President Bush and President Obama were in office at 39.6%, will provide you very substantial personal benefit? Yes or no?
That is not a yes or no question, sir.
All right, if you can't answer it.
As many people
Thank you, reclaiming my time. If you can't answer,
have different tax
reclaiming my time, please, sir.
And it is shown,
Mr. Chairman, I don't want my time taken if the witness will not yield.
I would recommend, Mr. Doggett, that if you asked a question, at least allow them to answer.
You can recommend it, but you're taking my time from
your
him
time
answering
is
the
moving,
questions.
so
Continue.
use it.
Let me say, I understand you can't answer that with a yes or no. I'm concerned about the weaponization of the Internal Revenue Tax Code by the President and your role in it. Section 7217 of the Internal Revenue Code makes it unlawful for the President and his partners like you requesting IRS to conduct or terminate an audit or other investigation of a particular taxpayer. Section 6103, as you're familiar, protects taxpayer privacy. Yet in violation of both, the President began threatening Harvard in April, and on May 2nd, he declared, we're going to be taking away Harvard's tax-exempt status. It's what they deserve. And you've been part of the we when you said on May 23rd that you publicly declared that you were moving forward on this, that there were a substantial number of rules that Harvard may have violated. Can you tell me, yes or no, whether you can pledge to avoid any interference in IRS audits or investigations of particular taxpayers? And if you can't answer that yes or no, just say so, and then I'll move on to the next question.
Sir, that is without question that I will follow the law.
All right, sir. Can you tell us whether, yes or no, you can report back to this committee in 30 days after investigating to assure us that there have not been any request by the President, any political appointee, or any family member of the President to direct or influence the audit or termination of an audit or investigation of any taxpayer or entity?
Well, Congressman, as you said, this is all private matters, so it would be out of line for me to report back on any of this. But I can assure you that I will follow the law and all proper procedures.
Thank you. I'm just asking you whether you can report back in 30 days whether there has been any attempt, I'm not asking for the specifics of who was involved, by the President or any of the other people I mentioned, to influence or direct any audit or investigation of a taxpayer. Can you do that, sir?
Well, I can report right here. I am not in the habit of repeating private conversations, but the President and I have never had a conversation on Harvard's tax status. So I will report that right here. We don't need 30 days.
I'm not asking just about Harvard. If they can pick on Harvard, they can pick on anyone, and I'm just asking for a simple report on whether there have been any efforts of that, whether from the President or one of his associates. And it would seem to me that would be easy to do. But let me move also to the question of privacy as it relates to data sharing. Do you agree that there is no authorization for the IRS to share tax data broadly with DOJ or federal agencies for the general purpose of data consolidation?
Section 6103 protects taxpayers' information. We have followed all proper procedures, and including in terms of the data sharing with the Department of Homeland Security, we are allowed to share taxpayers' information for those taxpayers who are believed to be criminals or have committed a crime.
I'm asking you about DOJ and its apparent effort to have an omnibus information sharing agreement with agencies. Do you agree that you cannot share taxpayer data without statutory authorization from this Congress, and you don't have any for that purpose?
We will follow the direction of the regulations and the court, sir.
Are you sharing any taxpayer information with DOJ for this omnibus information sharing agreement where they seem to probe into the privacy of every American, consolidating with Social Security and other private information? Or is there such sharing going on now, sir?
Well, first of all, I would push back on that characterization.
You can do so.
And
I just want to know if you're sharing in the time that
I will tell you,
remains.
and there seems to be a misunderstanding among many people on your side of the aisle on what DOJ is. DOJ employees.
I understand you had some misunderstanding about it, and Mr. Musk yourself, but let me ask you again, just simply on the question I'm asking, are you sharing any of this data with DOJ without congressional authorization?
As I said, we are following all of the laws.
Thank you. I would appreciate an answer to my question, but I will yield back since my time has expired.
Mr. Smith is recognized.
Thank you, Mr. Chairman, and thank you, Mr. Secretary, for sharing your time here today.
We're listening to Adrian Smith, Republican member of Congress from Nebraska.
Mr. Neal has, but I do want to bring in a bit of a historical perspective that I think is relevant. Looking back, you know, we can argue about CBO and JCT, and it's an imperfect system. And I think that's manifested itself in various hits and misses on projections, whether it goes all the way back to the original parts of the cost of Medicare that was way underestimated, or whether it was the structure of a more market-based approach with Medicare Modernization Act that precedes my time here, but actually cost a lot less than was projected. You go to the receipts, post-2017 tax action, the receipts exceeded what was projected. So we have an imperfect system, but it's what we have. And I think we need to go on that. Now, you take things a step further, and I remember the president's economic advisor, Mr. Hassett, pointing out that with COVID, yes, there was bipartisan action. I'll say that a few of those components still give me heartburn, as much as an emergency that we found ourselves in. But when, at the beginning of COVID, when unemployment spiked and the GDP dipped, Congress acted. By the end of 2020, GDP was back to about even. New President Biden was advised not to spend what he insisted on spending. I would suggest they're probably grappling with going back to the Obama stimulus, and they think that the only mistake of the Obama stimulus, so-called, was it didn't spend enough money, rather than address the bureaucratic approach that, you know, like the joke was shovel ready, maybe wasn't what it was described to be. But we have these imperfect projection systems, and yet we've got the reality of experience. And I think this is important to note, and especially on the IRS structure and the desire to spend money on more people at the IRS, because that could generate more audits and that would generate more revenue, and then we can spend that revenue that, good grief, still wasn't enough to cover what the actual IRA costs came in and came to be. So we have to deal with these realities, and it's because they're imperfect systems that we just have to acknowledge. And that's why, Mr. Secretary, I had not heard the numbers on the IRS, and especially in these efforts most recently, that we were told that if we pushed back on the number of new IRS agents and auditors, we were going to undermine the revenues, and yet a different approach that focused more on technology, because there was a willingness to focus more on technology here on this side of the dais than there was with just hiring more people that actually, even in the best of scenarios, did not come to be. Thank goodness, I might add. But we are in a situation now where in 2017, we did what was right, and I'm glad that there was bipartisan support to extend a lot of what we did in 2017 that did not have bipartisan support then. Now, that didn't pass the Senate. We are where we are, and now heading into a situation where what we have at hand with this reconciliation bill is good for workers. It's good for workers. It's good for economic expansion and encouraging investment and increasing productivity so that we can grow the economy without triggering inflation. President Biden was warned not to push more spending by Democrats, I might add. I think of Mr. Summers primarily, advising against that. Did it anyway. We are still paying the price. We're trying to dig out from a lot of that. And that's why we're doing the bill that we are. Gosh, I have other things that I'd love to ask questions on. But I think it's important to realize that we need to deal with reality here. That's what we are doing. And Mr. Secretary, thank you. I look forward to further conversations, whether it's trade, whether it's IRS. whether it's various things that we need to do to get our country to a better place, realizing that the solutions are really in the private sector and triggering everything we can on our side to encourage the private sector to provide more opportunity. Thank you. I yield back.
Thank you, Mr. Thompson.
Thank you, Mr. Chairman. Mr. Secretary, thank you for being here. You know, the economic outlook of the United States
Mike
is
Thompson from California.
Assumed office. We've gone from record lows in unemployment, historic growth, and lowering inflation to unprecedented trade wars, volatile markets, and low consumer sentiment. And for the record, Mr. Chairman, I would like to enter surveys from consumers from the University of Michigan, a trade war impacting the shipping economy, and the OECD article on the downward turn in economic turn in the U.S.
Without objection.
Thank you. This is only made worse by the Republicans' big, ugly bill and the administration's proposed budget. I have a few items I want to raise with you, Mr. Secretary, but given our limited time, I want to focus on the projected impact of the reconciliation legislation. Economists from the CBO, the JCT, the University of Pennsylvania, Yale University, the Committee for Responsible Budget, and the Bipartisan Policy Center have all projected that this legislation will add trillions of dollars to our national debt. Experts have also projected that close to 16 million Americans will lose access to their health care, and 11 million Americans will lose access to nutrition benefits. These figures aren't coming from Democratic talking points. They're coming from economic experts with years of expertise. Yet, Mr. Secretary, you have time and again gone public and said that you dispute these claims. I believe you're a very intelligent and very competent individual. You're a Yale graduate, an adjunct professor, served as the managing partner of the George Soros Fund Management Office in London, and led Key Square Capital Management, a global hedge fund, and you're a billionaire. So the question I have is, why is it that you seem intent on disavowing any and all expert opinions that are inconvenient to your political agenda? Unfortunately, it strikes me that you are hell-bent on ignoring the warnings of any independent expert whose opinions may not serve your goals. When you worked in finance and your analyst told you that a proposal was a bad idea, I suspect that you listened to your analysis and didn't just accept the deal because the person proposing it said they were wrong and that their deal was a good deal. That would be wrong, it would be irresponsible, and it would be dangerous. I would submit that in the position that you have now, it is even worse. It's more wrong, it's more irresponsible, and it's more dangerous. Mr. Secretary, can you point to one independent study, one study performed by an expert PhD economist who is not on the payroll of this administration, that says that this legislation will not add to our national debt?
Well, Congressman, if...
Yes or no? Can you point to one?
If we want to look at the CBO, which...
No, I'm not asking you, is there an independent expert that you can point to that says that this bill will not add to our national debt? Yes or no?
Yes.
There is?
Yes.
What are they?
Art Laffer.
Pardon me?
Art Laffer.
Art Laffer? Great. That I don't think that one counts. Mr. Secretary, did the 2001 Bush tax cuts add to our debt?
Sorry?
Did the 2001 Bush tax cuts add to our debt? Yes or no?
Again, Congressman.
Yes or no?
I think it's important to look at framing here.
Okay, I'm reclaiming my time. It's clear that you're not going to answer the questions that are asked. And let me make it real simple for you. The Bush tax cuts added to the debt. The second round of Bush tax cuts added to our national debt. The last Trump tax cuts added to our national debt. And every expert will tell you that the proposed Trump tax cuts will also add to our national debt. That is the honest answer, and I would have expected you could have just given us a yes or no on whether or not these preposterous tax cuts that will benefit clearly the most wealthy people, the people who don't need a tax cut in this environment, will add to our national debt. This is bad public policy. It's bad for the American taxpayers. It's bad for our economy, and it's atrocious for our future in regard to the national debt. And I yield back.
Next, we have the chairman of our tax committee, Mr. Kelly.
Thank you, Mr. Chairman. Thank you for holding me. Mr. Secretary, thanks for being here today. We get into these back and forth, and it comes down to who struck John. I think both sides of the aisle can
Pennsylvania
talk about things and policies in the past that caused wherever we are today to be wherever we are today. The question isn't about the history of how we got here. The question is, how do we remedy it? How do we fix it going forward? I'm from the private sector. And I really do believe before anybody should ever serve in public office, they should have been in the private sector and worked where they got paid on commission only and had lost their job at least once and had faced an unbelievable task of trying to keep your business open when there was no revenue coming in. So I don't want to grill you and all these things of asking you a question and not allowing you to answer it, because that seems to become the thing. I'd rather go back to consistency and certainty. The hardest thing for anybody in the private sector is trying to figure out what the next administration is going to do, or what's going to happen at midterms, and whether I'm going to make an investment or not going to make an investment, because that can change overnight. I get that, and I'm sitting here now and I'm trying to figure out. No wonder hardworking American taxpayers have lost faith in the way we operate. But I just want to ask you this, because I think it's really critical. So I have kind of a little bit of a football background. I look at this. We're in the fourth quarter now. It's a 2-minute warning and no timeouts left. I want you to share with us what could happen, and forget the Potomac amnesia about who's responsible for it. Let's go to what actually is going to happen if this bill doesn't get passed. How is it going to affect hardworking American taxpayers?
Congressman, good to see you again. It is what we call in economics a sudden stop. It would be cataclysmic. It would be the largest tax hike in history. It would be a disaster for businesses, for working Americans, and for our status in the world. That to have this happen, we would see increases in taxes on thousands of dollars of working Americans. We would see business contract, and we would see a substantial increase in the unemployment rate.
So as you look at what's taking place right now, and I think there's always the back and forth about do these tariffs work, do they not work? Just from a standpoint, your background is incredible for you to be in this position today. So I want to thank you for doing that, because you stepped out of a pretty comfortable life where people weren't firing questions at you and not allowing you to answer them. Just going forward, and you told people just now what's going to happen if we don't get this passed. So what is it that, in addition to what we could do, that we're not already doing?
Congressman, it is certainty and permanence. As we have seen, the corporate tax rate is permanent. We are not arguing on that here. Businesses have great certainty. Households do not. Small businesses do not. And this administration, myself especially, given my small town roots, they are laser focused that Main Street can do well here. And Main Street is a series of small business owners who work every week to make payroll. On average, 9 employees, family owned, and this would be cataclysmic for them. On the other side, having permanence, being able to invest, being able to hire more workers, being able to expand, will lead a Main Street resurgence. We will also see a manufacturing resurgence. Approximately 9% of Americans are now engaged in the manufacturing sector. History has shown us that wage growth occurs more readily in the manufacturing sector for working class Americans than in the service sector. So the combination of small business and manufacturing, along with the president's tax agenda for no tax on tips, no tax on overtime, a tax cut for seniors, and the ability to buy a new American-made car and deduct the interest, they will solve this horrendous affordability crisis. Because the way to think about it, Congressman, we are dealing with two things here. We are dealing with affordability, and we are dealing with inflation. Affordability is the stock of inflation, and we are working to pull that down. That can be pulled down two ways, through price levels or increase real wages. I think we can do both, but the real fill-up here would be increase real wages for working Americans. On the other side, we just saw yet another fantastic inflation number, much of that due to decrease in energy prices.
Thank you for being here, and again, for you to step out of your private life was just very comfortable. To step into this arena, I can't tell you how much I appreciate it. Thank you so much for being with us today and your service. We appreciate it. Thank you, sir.
Thank you.
Mr. Larson.
Thank you, Mr. Chairman, and thank you, Mr. Secretary, for...
We're now hearing from John Larson, Democratic member of Congress from Connecticut.
It's pretty clear, and listen, you know, who needs to get into arguments when you need answers? And but you can see the frustration on this side. I appreciate your loyalty to the president and understanding your responsibility, but it seems pretty clear that in the time that we're given to ask a question, et cetera, the reason that people are seeking yes and no answers is because of the time that's allotted. It has nothing to do with you personally or whatever. You're obviously very bright and intelligent. So, Mr. Secretary, would you agree that I give great credit to Representative Massey, who stood on the floor and addressed the Congress during the debate on this bill, and he never criticized the president. He never criticized a fellow Republican. What he did was address the facts, and he laid them out very clearly. Let me quote what he had to say here. This bill is a debt bomb ticking. Congress can do funny math, fantasy math if it wants, but bond investors don't. This week, they sent us a message. Moody's downgraded our credit rating, and the bond investors who buy and finance our debt demanded higher interest rates on a 10-year note, 20-year note, and 30-year note. What does this mean? Very soon, the government will be paying $16,000 in interest for paying $16,000 of interest alone per U.S. family. What are we telling them instead of taking care of that problem? We are going to give them a tax break. The frustration you hear up here, of course, is that there's denial that tax breaks don't add to the national debt. Was Moody's wrong? Was Representative Massey's assessment wrong?
I can tell you that clearly Representative Massey doesn't understand the bond market, and that any 24-hour window, as he's just said, is incorrect. That I will point out that the U.S. 10-year, which I repeatedly reference, is the only major 10-year bond that has a lower yield this year.
So
has a lower yield today than it did on January 1st or January 20th. German yields are higher. Japanese yields are substantially higher, but U.S. 10-year yields are lower. So I'm not sure what's on Representative Massey's mind.
So Massey is wrong. That Moody's was wrong too?
Moody's, even the Democrats say that.
What do you mean, even the Democrats?
The last time that the U.S.
I don't know. What do you have to do with Moody's? You know,
in 2011, when the U.S. was downgraded, Larry Summers, then NEC head, called Moody's a lagging indicator.
Is Moody's wrong or right? Yes or no?
Moody's is a lagging indicator.
Okay,
and
so
anyone who
you can understand the frustration, and I appreciate your intelligence and ability to talk over. But when we're addressing the American people and we're in a hearing like this, someone as bright and as capable as you are could explain to the American people and still remain loyal to the president, loyal to our colleagues on this dais who supported the bill. There is a strong difference of opinion. And that's what is being expressed here, opinion. There's no focus or dedication on the actual facts. We'll find that out, and people on this aisle are saying, well, don't worry, there's going to be no impact on kids not getting food, 16 million people being kicked off of their health insurance. That's some mirage. That's some fictitious notion that Democrats have made up. And this national debt stuff, well, whether it's Moody's, whoever it is who has come out, whether it's the Wharton School, they're all wrong or misguided or uninformed, as Secretary Massey was. I yield back.
Mr. Schweikert.
Thank you, Mr. Chairman. Mr. Secretary, how's the jet?
We're listening to David Schweikert. He is Republican member of Congress from Arizona.
Look, it's impressive, but I don't know if you get frequent flyer miles for all this traveling.
No, but I take my responsibilities of reporting to Congress very seriously.
No, we appreciate you making the effort to get here. I'm going to give you something that's a little bit different, but it's more some of the things we specialize with the Joint Economic Committee and those. We'd like to actually engage, this is probably more technical staff, on what we can do to actually, there's things we can do policy-wise, message-wise, product-wise, in regards to moving away from notes and bills and being able to create some additional interest liquidity on the bonds, moving out in the curve. And with past Treasury secretaries, we've done presentations on everything from Professor Schiller's Trill's idea, where it's a bond, but it actually has a slight attachment to as an equity interest in the U.S. tax receipts, so therefore it's sympathetic with tax revenues, to things you've actually written about or your team around you have written about, certain gold indexes and other things for long-term debt. My interest is very much, and this is a intellectual conflict many of us in Congress have, the substantial portion of growth of debt is demographics. We don't like to tell people the truth, but we have a dramatic shortage of young people in the country. Today, compared to 20 years ago, we have double the number of people 65, but our 18-year-olds are exactly the same as 20 years ago. It's demographics. And we're going to try to make demographics partisan because that's what we do. How does someone like me work with your team to actually give you product ideas, messaging to the markets and liquidity that going along on the curve is stable, and we're going to be there to protect our full faith and credit?
Congressman, you raise a very important issue, and what you were talking about is something called the dependency ratio. The U.S. is the only major industrialized economy where that ratio is roughly stable. It is in slight decline. Many other economies, Italy, Japan in particular, they are seeing the dependency ratio blow out, and hence their productive capability. We would welcome the opportunity to engage with you and your staff on any ideas that you may have. Right now, we are committed to the regular cadence of Treasury issuance as it is. I would add that in my lifetime, and I can't believe, to go back to experts, we always see, it's this industrial revolution, it's that industrial revolution. I'm not sure whether we're on the fourth or fifth, but I do believe that we are on an industrial revolution, an AI revolution that may lead to a productivity breakthrough that could be very important.
Mr. Secretary, you're stealing one of my speeches, but synthetic biology, AI, automation, and that's actually, it's a side conversation on reindustrialization and the actual statistical information of how much of that's going to be labor substitute by automation, and therefore we may not get the same wage growth in the academic literature, but that's going to geeking out a little bit. My great interest is, I don't believe many of us on this committee have spent enough time, whether it be a Democrat in the White House, a Republican, on debt management and the fact we on this committee have the responsibility to work with you in Treasury to have as much stability in that model. Because today we borrow, what, about $72,000 a second? Outside the math for extraordinary measures.
I haven't done it by second, but I think on a daily basis. But Congressman, I can tell you, the thing that would give us the greatest debt stability is the increasing the debt ceiling.
No,
because
I don't disagree
that is a cataclysmic outcome that we will never allow to happen.
Mr. Secretary, absolutely agree.